American capital markets is the envy of the world.
The equity market is doing really, really well, despite the economy not being particularly healthy.
People like myself, I think, underestimated that role of AI, and I think it helps explain the resilience of the U.S. economy.
Even if the AI narrative continues, it might challenge the fact that we look around and say everything is extraordinarily expensive.
As difficult as it is, and it is difficult to invest in these valuations, we think that you need to stay invested.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Heading into University of Michigan Friday. I cannot believe that I'm saying those words, with the U.S. government shut down for a 10th straight day. The economic data of corporate earnings continuing to show a resilient U.S. consumer. And Treasury Secretary Scott Bessent making good on his pledge to support Argentina's currency, very much in the forefront amid a whole slew of questions around governments around the world.
So when it comes to potentially having more data, because as you say, you're starting the show talking about University of Michigan, something I've never thought I would hear you say. We are in a data desert, so you have to dig deep. But potentially, Bureau of Labor Statistics are going to bring people back. By the end of the month, we might actually get inflation. I think that's a positive note to this market. When it comes to political instability, the U.S. government, really unprecedented moment, setting this $20 billion swap line, buying pesos. Financially, they are trying to shore up the markets in Argentina and also really give a backstop to Milei as he goes into a very difficult midterm election at the end of the month.
Well, this is an awkward moment. And as you point out, this promise to Argentina that was made good on by the United States comes at a time when U.S. workers are starting not to get their paychecks. And there's increasing questions around buying soybeans. And one person could argue it actually makes sense for the U.S. to fortify Latin American relationships to compete with China in that region. On the flip side, are they effectively doing that when it comes to issues like soybeans in Argentina?
Well, the Treasury Secretary made this point last night on Fox News. He was talking about he doesn't want China to still be ingrained in Latin America. He made this point to me in April in Argentina. It was his first trip as the Treasury Secretary. He talked about the fact how China has all these mineral deals in Africa and they don't want that to happen in Argentina. But politically, the blowback at home, it's going to be pretty stiff. We already see Senator Elizabeth Warren talking about this and wanting more questions and answers in regard to this swap line, as well as already on display the issue Brooke Rollins is having in terms of China not buying cargoes of soybeans from the United States, but they are looking to Argentina.
It is sort of a mess, and that's the reason why maybe we're seeing a pause in the stock market. Right now, you're seeing equities not doing much. You do see a little bit of a softness ahead of the open in futures after yesterday's declines. And really, it was a broad-based decline. I think it's really important to say that stocks, bonds, and gold all moved lower yesterday, which is ironic considering that gold was supposed to be the diversifier. Yesterday, it was silver. Today, you see a bit of a reversal of that, with 10-year yields down 3 basis points, 410.73 after that 30-year auction that was a bit soft, but at least had strong demand. A little bit of dollar weakness. This comes after the biggest potential weakening, strengthening of the dollar so far, going back several months. Coming up this hour, Christian Nolting of Deutsche Bank will be joining us with that stock rally, pausing, even though we are near record highs. Ajay Rajadhyaksha of Barclays on gold's record run, and Doug Rediker of International Capital Strategies on the historic U.S. investment in Argentina and what the implications are. We begin this hour with stocks trying to rebound, maybe, but actually softening as investors look ahead to earnings season. Christian Nolting of Deutsche Bank writing, Friday will be data heavy, which will help shape expectations for the Fed's next move, especially as markets weigh the balance between improving sentiment and lingering fiscal concerns. Christian joins us now. Unfortunately, we don't have a lot of data because of the government shutdown. I do wonder what you make of the fact that we saw stocks, bonds, and gold all sell off yesterday in tandem at a time when a lot of people are talking about diversification.
Yeah, of course, diversification is very, very important, as we all know. But I would just say, if you look, for example, at gold, after such a rally, if you look at some indicators like RSI, it's really overboard. It was above 80 on RSI, so now it's below that. But I think it's not a surprise. And I would say, even if you see gold correcting a little bit, I would say it's a healthy development, but we would buy that dip on gold, because I think that story for gold is not over from our point of view. And so I would say also on the equity side, as you said, we've seen quite a rally. Last day's markets were a bit sideways. And as you rightly said, it's about the earnings that are coming in for further market development and market direction.
So we're learning that actually demand is pretty strong in the U.S. We learned that from Delta. Levi's was really interesting yesterday because they actually upgraded their expectation for earnings, and yet their shares fell out of bed because they increased their expectations for the tariff hit. They said consumers were taking on that tariff increase in costs and actually paying higher prices. What's the conclusion? And I understand that it's early, but what is the conclusion from the earnings we've gotten?
So I would say if you look at the earnings, first of all, the market is not as much expecting from a growth perspective as for Q2. If you look at Q3, I think that's good news. On the other hand, if we weigh this a little bit, what you can see is that the earnings revisions were not as much lowered as before for Q2. So from that perspective, the market probably is a bit cautious, but I think it's not expecting too much. So there is a room for companies to be better. From that perspective, I think we do expect the earnings season to be okay-ish. If you think through of the tariffs, I think we see the pass-through rate so far being quite low. That might be increasing a bit over the next months. And our conclusion from that is what we've been saying before, we don't see inflation to come down quickly. So it's rather staying at levels where we are or slightly higher. So from that perspective, we are not surprised that yields, if you look at 10-year treasuries, for example, are above 4. We would say 4.25 is possible in 12 months' time.
Right now, and to Lisa's point, Levi's is talking about how the consumer is able to handle what's going on with tariffs. But when more rates get passed on, as you talk about in coming months, how difficult is that going to be for corporate America to continue pass on higher costs?
I think you need to take this into account, right? So do companies take that from their margins, if you want? Or is the consumer able to digest this? I think so far the economy in the US is very strong. We do see a soft patch. So just to give you some numbers for Q4, over Q4, we do expect a growth rate of 0.8, so 0.8. But if you then look with fiscal spending into next year, if I meet you again in Q4 2026, the growth rate we have Q4 and Q4 is 1.7 already. So it's a soft patch. But I think the growth in the economy could help the consumer as well.
Christian, how difficult is this moment with the U.S. government still shut that we do not have the gold standard data coming out of the United States?
Yeah, it makes things a bit easier, right? So I see on your ticker as well, shutdown of the U.S. government. Be careful what you're doing there in a way. But we have been living through government shutdowns before. So from that perspective, I'm not so concerned. Of course, you fly a bit blind, but we think we don't need to change our forecast at this point in time. If you look at equity markets, for example, government shutdowns have not been really completely negative. I mean, the longer they take, there could be higher volatility. But we are not that concerned about this one because we think, even it might be a bit longer, but at one point in time it will come back and then we get the data. They might be disrupted, then they might cause some volatility. But from our point of view, we don't need to change strategy because of this.
I love it. It makes it easier because there are fewer numbers to analyze. So, go home early. I guess I am wondering, though, does it make things like the University of Michigan sentiment survey take on renewed importance, even though it is sort of a disputed indicator of exactly what it's measuring?
No, of course, as you rightly said at the beginning, right? You try to get everything you get from the data perspective. So, for example, ADP, when you don't get the non-farm payrolls, you really watch closer. But of course, you need to take into account what kind of indicators are there. And I think, for a certain period of time, you probably can fly a bit blind from the data perspective. So you look at the markets, at diversification, as you're saying. But we have a clear view, as I said, soft patch, but then increasing. And so we would be very surprised if that's changing.
How do you deal strategically, Christian, with things like the credit line in Argentina, like this question of companies that could get caught up in the crosshairs of international disputes, as we're seeing this morning with the likes of Qualcomm in China? I mean, how do you deal with political threats that are new and that could potentially strike specific companies?
Yeah, look, the whole year was about this already, right? So there's a lot of discussion about tariffs, geopolitical risks that came this year. But so far, the markets have done quite well. So I think it helps a lot to look at sectors. It helps a lot to look at companies that work globally and how they are impacted. And of course, what we have been seeing this year, what's not so much impacted to a certain extent is the AI trade. You talked about this before. So from that perspective, that's why we look at earnings. And as long as we get them, I think this trade is up and running. And that's clearly a driver for markets, especially in the US. But then on the other hand, we look at markets which probably have so far a bit of negative sentiment, and sentiment is then turning better. And talking here from Germany, we had some weakening sentiment, I think, but now the government has started to put some measures in place, and we do get more calls from clients from outside, from Germany, from Asia, from the US as well. And so maybe we see a change in sentiment here, which would be positive for markets.
Christian Nolting of Deutsche Bank, thank you so much for being with us. We hope you enjoy your weekend. We were talking there about Qualcomm, and China came out this morning opening an antitrust probe of Qualcomm's auto talks deals. It just highlights how this sort of effort to try to gain leverage ahead of any kind of talks between President Trump and Xi Jinping is escalating and moving to more industries.
We're going to see tit for tat every single day until those two leaders sit down. And we saw a number of not just Qualcomm, but a number of salvos coming out of Beijing overnight, as well as when it comes to ports and ships. So we're going to see this tit for tat until these two leaders sit down. What's interesting, what's so complicated for Qualcomm, probably why their shares are down some 3% in pre-market trading, is because they get almost half of their revenue from China. So when China goes after them, it's a really big deal.
And this is a reason why it's becoming a really fraught territory, particularly in the semiconductor space, to get involved and try to predict what the political backdrop is going to look like. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Tahira Anand. Tahira.
Hi, Lisa. The U.S. has launched a bailout for Argentina, offering $20 billion in financing and carrying out a rare intervention to prop up the peso. Treasury Secretary Scott Bessent announced the currency swap and government purchases in a social media post. Trump's support for Argentine President Javier Milei comes ahead of this month's midterm elections in Argentina. Meanwhile, President Trump is doubling down on his threats of sweeping cuts to Democratic priorities as the U.S. government shutdown continues. Speaking at a cabinet meeting, Trump repeated his warning of cutbacks while blaming Democrats for the shutdown. Government workers and military personnel are set to miss paychecks today. And Maria Corina Machado of Venezuela has been awarded the Nobel Peace Prize for 2025. Machado winning for her work promoting democracy and decades-long struggle against authoritarianism in Venezuela. Known as Venezuela's Iron Lady, Machado has been in hiding for more than 14 months after Nicolas Maduro declared victory in the disputed 2024 elections. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, day 10 of the government shutdown.
We'll be cutting some very popular Democrat programs that aren't popular with Republicans, frankly, because that's the way it works. They wanted to do this, so we'll get a little taste of their own medicine. We have no idea who we're dealing with over there.
Ed Mills of Raymond James joining us next. This is Bloomberg Surveillance. It is day 10 of the government shutdown, and right now what you can see in markets is just an inability to find direction. So many crosswinds underneath that we are essentially paralyzed at 6779 on S&P 500 futures. And the Russell 2000, you're seeing a little bit of a lift, and maybe it's coming from the bond space. If you take a look at what's going on in 210s and 30s, you do see a rally led by the long end. It comes after yesterday's 30-year auction that was not necessarily a screaming buy in terms of just the concession, and yet you did seem to see the internals really support demand for the longer end yields. Those yields down almost 4 basis points at 468.51. Meanwhile, the precious metal of the moment, silver, up more than 70% so far this year, up again this morning, another 2.4%. And Annmarie, what I find fascinating is this is a metal that actually has an industrial use well beyond just keeping in your basement and feeling that you can sleep at night.
Yeah, it's dual use. Usually when gold rises, sometimes the, was it stepkid, ugly duckling cousin, silver also rises along with it. But to your point, there actually is a use case for silver, not just in a store of value and assets. So it's also getting some love.
Yeah, almost half of the demand is coming from industrial uses. Under surveillance this morning, day 10 of the government shutdown.
We'll be cutting some very popular Democrat programs that aren't popular with Republicans, frankly, because that's the way it works. They wanted to do this, So we'll give them a little taste of their own medicine. We have no idea who we're dealing with over there. Republicans have voted repeatedly to pass a clean, nonpartisan bill to reopen government. We're not going to do anything only good for health care. We're really, I think, become the party of good health care.
Here's the latest. Government workers are preparing for missed paychecks today as the shutdown enters its 10th day. Congressional leaders are still at a stalemate as President Trump threatens sweeping cuts. Bloomberg's Tyler Kendall joins us now. Tyler, do we have any sense of where the potential plates of progress could come from? Have there been any? Is there any sign of progress?
Yeah, hey, Lisa, good morning. At this point, there are no indications that either side is letting up. Republicans are really holding firm that they will not negotiate until the government reopens. Now, our understanding is there are informal bipartisan talks happening on the Hill, but that leadership is not engaged. For example, this week we got sort of an insight that there are some discussions happening about what potential structural reforms could look like for the Affordable Care Act premium subsidies, such as a potential new income limit in exchange for an extension to those tax credits. But leadership says that they're not going to talk about any of those changes until the government ultimately reopens. And pressure is definitely mounting. As you mentioned, today marks the first missed paycheck for many federal workers. And I'll point out that the Senate left town last night. They're not going to be back until Tuesday. That is one day before October 15th, when many members of the military could also potentially miss a paycheck. Now, our analysts at Bloomberg Economics say that if this shutdown extends into a third week, which at this point with the Senate out, it looks likely, the U.S. unemployment rate could jump from 4.3 to 4.7% as furloughed workers are counted as temporarily unemployed, which is just a good reminder that 750,000 federal workers are expected to be furloughed during this shutdown. And Lisa, while we are talking about data, important to point out that a person familiar tells us that the U.S. Bureau of Labor Statistics is calling back some of its employees to prepare the September CPI report that was also supposed to be out next Wednesday. At this point, it does not look likely that they will make that deadline, but it is expected to be released before the next FOMC meeting at the end of the month.
Tyler, you asked the president about troops getting paid next week. We have a number of organizations that represent the National Guard, that represent the more than 1 million currently serving active duty service members, writing to their House and Senate representatives asking for a standalone package. Is there any sight on Capitol Hill that there is going to be legislation to pay our troops?
Well, President Trump told me, Annmarie, that he would encourage Congress to pass a standalone bill to pay our military. He did say that he thinks that the issue will be resolved by that October 15th deadline. But at this point, House Speaker Mike Johnson is holding pretty firm that they are not going to put that up for a vote. Republicans are really trying to hold this line that they are not going to negotiate. They want Democrats to pass exactly what's in front of them, which is that clean stopgap measure that would fund the government until November 21st. Now, we have to see if the pressure mounting will continue. The House Speaker did hold a phone-in town hall yesterday on C-SPAN where he heard from many members who were urging him to pass some sort of standalone legislation. But, Annmarie, at this point, we haven't gotten any indications that that's going to move.
Tyler Kendall, thank you so much. We'll be speaking with you throughout the morning. Meanwhile, Ed Mills of Raymond James writing this. A short-term continuing resolution is likely, though we cannot rule out a prolonged shutdown through November. Ed joins us now for more. Ed, can you just lay it down what actually is happening, who's offering who what, and whether there is actually genuine negotiations on both sides or whether this is just all politics?
Lisa, at this point, I'd say this is mostly politics. I don't think much is being offered in either direction. And in many ways, this is the shutdown that isn't. If you are a government worker, if you're a member of the military, this is very real. This is very personal. But let's look at what else is happening in Washington, D.C. Yesterday, the Federal Reserve held a community bank deregulation summit. We have a peace deal potentially here in the Middle East. We have a Trump-Xi summit later this month. The Senate actually passed the defense authorization bill. That is almost as if there is a government shutdown that's just in the background, that we're not really focused on that. Previous government shutdowns, it was like a 24/7 news story. It was really the only thing that was going on in Washington, D.C. So to the extent that it almost feels normal, that there isn't the pressure to reopen it, there isn't the kind of all hands on deck approach here, really does push me to say, when you ask me about the timing, right now, Lisa, I'm taking the over.
Ed, though, I hear what you're saying, but if you listen to that C-SPAN call yesterday with Speaker Johnson, you had Americans around the world, especially individuals whose families are active duty service members, incredibly angry. Do you think at some point, if this lingers, they're going to be forced to make moves?
Yes, I mean, we're going to reopen, and I think that when we've asked, kind of questions, and we've gotten, kind of this, at Raymond James here, what actually forces this open? It is missed paychecks. It is an actual impact on day-to-day lives of Americans. We're starting to see slowdown at airports as TSA lines get longer, as kind of flight delays get longer. That pressure builds. We probably need to see one of the political parties make a mistake. Right now, Republicans get slightly more blame in most polls, but it is kind of not overly skewed in one direction or another. Democrats feel like they are fighting the good fight, and they feel that having a conversation about healthcare is important, and they feel as if they have this fight and they have a situation where kind of Americans who are on the Affordable Care Act get significant increases, that they will politically benefit from that. I go back to the 2018 elections. How did Democrats win the midterm election when Trump was in office the first time? Make it about healthcare. That's what Democrats are doing here. So right now, these battle lines are still being drawn. The pressure hasn't built to the point where someone feels as if it is absolutely necessary to reopen, because so much else is going on and so much bigger fights are happening here in D.C.
But Ed, just to be clear, because former Speaker Nancy Pelosi said it wasn't a clean CR, and then Minority Leader Hakeem Jefferies was on our program yesterday saying it wasn't a clean CR. What is on offer is a clean stopgap funding measure. Is that correct?
Yeah, there's some, most of it is a clean CR. It's a 7-week extension of the current budget. There were some additional things that were added on there, especially more kind of security support for kind of members of Congress and other government officials. And traditionally, Democrats have always said, if it is a clean CR, you vote for it. The Republicans have not voted in the past sometimes for those clean CRs, and Democrats have been able to message that. But Democrats are also saying, because there are some cliffs coming, especially on the subsidies for the Affordable Care Act, Obamacare, that doesn't make it clean. Right now, it's mostly a rhetorical fight. This here is kind of something that Democrats, kind of like the fact that it is mostly clean so they can talk about healthcare, rather than oftentimes we're dealing with all of the appropriations bills and we have messages across the board on what's in there on healthcare, what's there on education, what's there on defense. So I think Democrats strategically decided to do it when it was mostly clean so that they can say it's about healthcare rather than all the other things that are part of this government budget.
How palatable is it, Ed, for people in the United States not to be receiving paychecks from the federal government at the same time that the U.S. is offering a $20 billion swap line to Argentina?
Yeah, it's politically difficult. I mean, I think that when we look back to the longest ever government shutdown, that was 35 days back in 2018. And the reason it lasted that long was the Defense Department was already funded. I think that the military members in particular are going to be something that the American people have a hard time not getting paid. What I'm watching for, is there going to be something that President Trump tries to do creatively to pay even outside the appropriations process? We've already seen the president say that he's going to use Section 232 tariff money to fund WIC and SNAP benefits for women and children of economic need. Is he going to use some of that funding for the military? Is there going to be a push to kind of change the conversation here? One thing I've always noticed about President Trump is he does not stay on the defensive very much. He always goes on the offensive. Yesterday in the cabinet meeting, he was threatening Democrats about different programs that he would cut. Does he take that money and move it over to the military? Does he find a way, even if he's going to get sued, to fund the military to try to put pressure on Democrats to say that lever is not going to be the thing that gets you to reopen this? You have to come to the table and do something different if you want me to negotiate.
Ed Mills of Raymond James, thank you so much for taking the time this morning. Coming up, Ajay Rajadhyaksha of Barclays on what's driving gold's record run. Plus, Danny Berger with your morning movers. Applied Digital soaring on a new data center deal. This is Bloomberg Surveillance. Stocks struggling to find some direction, understandably given how many different aspects are at play geopolitically, but really underpinned by the idea that we are near record highs still. So not exactly really doing too badly. 6779 on S&P futures, going nowhere on the NASDAQ. Russell 2000 seeing a little bit of a bounce up 0.2%, coming alongside the move that is going on in bonds, where you do see a rally, particularly into the long end, with yields down something like 4 basis points, 4.69% across the board, seeing fairly strong auctions on the 10-year and the 30-year this week. I mean, yes, a concession, but still the internal demand dynamics have been good. Meanwhile, in gold, yesterday, a pause after a huge screaming run of about 50% so far this year. Today, trying to pick it back up about 0.6% as people take a look at where they can find a haven amid geopolitical instability. 3 hours away from the cash open. Here is your morning movers with Danny Berger. Danny.
Hey, Lisa. Qualcomm getting hit this morning, down 2.7%. News from state regulators in China that Qualcomm is being probed over anti-monopoly charges. It bought Autotalks earlier this year. It's an auto tech company that lets cars talk to each other, essentially for safety. The allegation here is potentially that they did not properly report that acquisition. So again, shares down almost 3%. Also on the move this morning is Applied Digital, up nearly a quarter, up 22%. This is a data center company. Reported earnings are really strong. But within that, it also said that CoreWeave was signing one of its leases. Again, there's this really big hype around the AI trade and finding out who the winners are. Data centers, especially with Microsoft saying yesterday that there is still a data center crunch that will persist into 2026, making these companies attractive for investors this morning. Finally, things to the downside. Levi Strauss. Lisa, I know you've been talking about this morning. The fact that Levi's beat on its earnings, not only that, but its profitability also held up and improved. The issue is the CEO saying that tariffs are starting to bite. Clearly not showing up in their margins yet, considering that they've been able to find more profitable channels and raise prices and have consumers buy it. Still, these shares have run up a lot to date, so shares falling nearly 7% this morning, Lisa.
Danny, thank you so much. I'm so glad that you really went into that, because to me it was a fascinating story, and I wonder how much this is investors just not believing they're better than expected projections, considering some of the tariff headwinds.
And also, these are the tariff headwinds now, when most economists are coming on the program and they're saying a lot of companies were able to absorb more than half of the tariff impact, and next year is going to be the pass-through. Do Levi's have to even raise prices again come 2026?
Which is what we're hearing from some CFOs, with the question around whether consumers will absorb it. And in Levi's case, so far, they are doing just that. On our radar this morning, talk about political instability around the world. Japan's decades-old ruling coalition has officially collapsed. The Komeito Party ending its 26-year partnership with LDP, delivering a major blow to Sanae Takaichi's bid to become the country's first female prime minister. You are seeing just a touch of support underneath the yen, with this idea that maybe this would be the key indicator that would force the Bank of Japan to hike rates later this year, should there be a bigger sell-off, a bigger weakening in the yen. President Donald Trump announcing plans to travel to Israel for the expected release of hostages under the Gaza peace deal. The president saying he hopes to be there when the hostages return next week, and added he might address the Israeli parliament, the Knesset. The U.S., meanwhile, launching an effort to stabilize Argentina's economy. Treasury Secretary Scott Bessent announcing a $20 billion currency swap and a rare market intervention to help prop up the sharply declining Argentine peso, which really is fascinating, considering, Annmarie, that we wondered whether he would make good on this, or whether it was just the promise of some sort of swap line that would be enough to really stave off any kind of massive weakening.
I was with the Treasury Secretary in April when he made his first trip internationally, and it was to Argentina to show this support for Milei. And I asked him, are you going to potentially do something when it comes to more of a swap line? What kind of tools on the table? And they said, no, not at this moment. Clearly, things got bad for when it comes to Argentina and the markets. And mostly that's because a lot of individuals and investors are concerned that more leftist policies might creep in if Milei doesn't succeed, which is why you have this. But you bring up the point, the political blowback at home is going to be very challenging. We saw this with text messages from the Agricultural Secretary Rollins to the Treasury Secretary. If you want to make America great again, then why are you buying pesos, especially when Argentina, it now has an avenue to sell soybean cargoes to China, and they're not buying U.S. cargoes.
And it's a pretty narrow bet that Javier Milei will win. and then will fortify some sort of stability in the peso, given that he just had a pretty big political blow in a recent local election. So how much will this swap line continue should he lose the next election later this month?
Right. And the problem they have that if they don't have Milei in Latin America, the way the Trump administration sees this, their concern is there will be a government that is more friendly when it comes to China. And the Treasury Secretary made this very clear last night. He said what they want to do in Latin America is make sure that these countries are turning to Washington, not Beijing, in times of trouble.
Yeah, so this to me is really the key question. And honestly, I want to rip up the script and go right to our next guest, Ajay Rajadhyaksha of Barclays, to talk about what we're seeing with respect to the international picture, how much that's edifying what we're seeing in the gold trade, but also how difficult it's been to really make some sort of international call. When you take a look like Argentina, how much does that complicate the emerging market bet? I mean, how much does that complicate understanding what the calculus is there?
It does, but it depends on the asset class you're talking about. So on the bond side, it does matter hugely. But on the equity side, remember, Lisa, you're talking about an EM equity asset class that is primarily dependent on what China does. Not so much Argentina, not so much Brazil, not even at this point India. Indian equities have basically treaded water for a while. But the Chinese equity market has been on a tear. And that, I think, is the wind beneath EM's wings for the foreseeable future. So there's noise, yes. But this is not going to upset the EM equity rally.
This is fascinating because how much is China the wind beneath the sails of gold? We've been talking all about gold as being this debasement trade, but you're not seeing it necessarily in treasury yields because you are seeing some kind of demand at the auctions. Is this really just central bank buying led by China that's fueling in a narrative that's taking on a life of its own?
It is partly central bank buying, and it started in 2022 when the West froze Russia's FX reserves. We saw an immediate pickup, almost double the amount of buying in 2022 from central banks relative to 2021. And it has not let up since. Central banks have bought over 1,000 tons of gold each year starting in 2022. They used to be at barely 300 to 400 tons. But part of it is also the lack of supply. Weirdly enough, despite gold prices basically tripling in the last 5 to 6 years, the amount of supply, call it geopolitical issues, call it geological issues, but the amount of supply really hasn't picked up anywhere near as much as you expect. And then that is the third thing, what I think you're referring to, which is just uneasiness about the global financial and monetary order.
When it comes to that uneasiness and the central bank buying, what's the impact of that? Because that means then they're not buying as many U.S. treasuries.
That is actually a very clear impact. So for the first time late last year, by our estimates, the amount of FX reserves globally held moved to a majority, not a majority, but more FX reserves were held in gold and US treasuries, which is not something that has happened for a long time. Like you guys just said, it is true that it's not shown up in a lack of auction demand, for example. But if you look at swap spreads and where they are right now, they still seem to be screaming that on a relative basis, sovereign debt is still not as much in favor as all-in yield levels would suggest.
Do you call this the world de-dollarizing?
No, I think the world, it's not so much one currency versus another. Because let's face it, there is not an alternative to the dollar. The renminbi is not an alternative. The euro has its own problems. The yen used to be a safe haven, but has struggled in the last 3 or 4. The Swiss franc, quite frankly, is very expensive, too small. So it's not de-dollarizing as in the world moving to other currencies. But the world absolutely is worried about how much we are awash, both in fiat currencies as well as in the trillions of dollars of sovereign debt with the promise of trillions more to come. That is the uneasiness that I think investors are turning to gold for.
I wonder if we're just trying to create narratives around a liquidity picture that people don't fully understand. And as the head of research at Barclays, I'm sure you track the liquidity pictures and the idea that you're having the fiscal and the monetary engines kind of firing at the same time. How much do all assets end up trading in tandem? And I know I shouldn't make too much about this, but the fact that stocks, bonds, and gold all sold off yesterday sort of hinted at this question around liquidity almost as much as some of the narratives that we're trying to put around them.
So I'm less worried about, you're talking about too much liquidity in the system.
And then being withdrawn, and how much that ends up really kind of creating the dynamic in markets well beyond any question around geopolitics or loss in U.S. exceptionalism,
right.
weakening growth beyond, et cetera.
So I think yesterday, just to address that, smaller question first, was not about liquidity, partly because, like you said, gold was so overbought. The RSI, I have just never seen it. When something goes up 50%, it's not crazy for it to take a little bit of a breather. Equities, I would say the same thing. Bonds, we are running, according to the Atlanta Fed, at a 3.8% quarter-on-quarter growth number annualized for the third quarter. That is a nominal GDP print of over 6%. At some point, bonds are supposed to start to reflect that, and I think that is what they were doing. But I do think that the Fed is laser focused on the amount of bank reserves it starts to take out of the system as it continues with QT. Now, the problem that they have is the way that there is a problem is when there is a problem. We are all guessing at what is the correct level of bank reserves. But if I had to guess, I think they would err on the side of caution, meaning leave too many reserves rather than too few. And that, again, is gold, Bitcoin, silver positive.
So is it very difficult to be bearish in anything right now, considering that that's the backdrop of liquidity?
It's hard to be bearish given the economic outlook. We've turned, you notice, neither of you guys has asked me a single question on tariffs, and there's a reason for that. We have turned a page on what used to matter. There's this massive AI boom, which even if it ends up with some problems along the way, this amount of spending there's names, Lisa, that I never knew. Colossus, Rainier, Stargate, these are all fantastical names, except that they are all gigantic data centers, each one of them half the size of Manhattan. And that spending is not going to go away. And while that is going on, I just see no reason for a big pullback in most asset classes.
Ajay Rajadhyaksha, thank you so much for being with us. Ajay Rajadhyaksha of Barclays joining us here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Senate passed a bill that would require top chip makers, including NVIDIA and AMD, to ensure that U.S. companies get priority access to their products before China. The bill's path to becoming law remains unclear as the House passed its version without clarifying language on export controls. Lawmakers must now negotiate a final package. Meanwhile, a grand jury has indicted New York Attorney General Letitia James over fraud claims after calls from President Trump for her prosecution. Court filings show she was charged with bank fraud and making false statements to financial institutions. In a statement, James called the charges baseless and a weaponization of the justice system by the president. And Paramount Skydance CEO David Ellison says more content is key for his company going forward. Speaking at Bloomberg Screen Time Conference in Los Angeles, Ellison made the case for what he sees as the best path forward to keep up engagement and bring value to shareholders.
You actually need more content to yield more engagement, more movies, more television series, more to get to scale, because you need that content, you need that great storytelling to yield engagement.
Ellison also said he sees more consolidation ahead in the media space. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. I've got to say, I feel like a lot of choices. Just saying. Up next, aiding our allies.
Argentina is a beacon in Latin America. We do not want a failed state. We are going to use Argentina as an example. We back up our allies.
Doug Rediker of International Capital Strategies joins us next. This is Bloomberg Surveillance. Stocks looking for direction this morning after a pretty big week. More gains until yesterday when suddenly there was a halt, particularly led by a number of the broader stocks. A question here about tariffs, the ramifications for some of the retailers in particular. Under surveillance this morning, aiding our allies.
Argentina is a beacon in Latin America. We do not want a failed state.
So this isn't a bailout?
Sorry, it's not a bailout at all. There's no money being transferred. We are going to use Argentina as an example. We back up our allies. President Milei has done the right thing. He is also a great ally for the U.S. He'll be coming to the Oval Office next Tuesday.
Here's the latest. The U.S. finalizing a $20 billion currency swap framework with Argentina's central bank. Bloomberg's Michael McKee joins us now. Mike, can you just give us some perspective on what swap lines like this have been used for in the past, how frequently they are used by the United States?
Well, they did two things yesterday. They finalized the swap lines, and they also intervened in the currency markets to buy Argentine pesos. Those two things related but not necessarily connected. The U.S. has bought foreign currencies 3 times in the past before this Argentina one, to aid Japan twice and once with the euro, but they haven't done it since 2011. The swap line is an interesting thing that we really don't know a lot of details about at this moment. Normally, swap lines are between the Federal Reserve and the central banks of other countries. The idea is to be able to provide dollars when dollars are short for companies in those countries who have to pay back dollar-denominated loans. And what they do is they send us a certain amount of money. Say Argentina would send $50 billion worth of pesos, and we would give them $50 billion. We'd hold on to the pesos, and then we would send them back, and they'd send us the dollars back when that's over. But this appears to be a Treasury swap line, and the details haven't been really made public, but it's maybe analogous to what happened in the Mexican peso crisis, where the Treasury Department used the Exchange Stabilization Fund, the same thing that they used yesterday to buy pesos, to basically guarantee Mexican debt. They couldn't roll over their tesobonos, so the U.S. guaranteed that the debt would be good, and they gave some money in swaps, but not a whole lot. And then the Mexicans guaranteed that loan and the guarantees from the U.S. by pledging oil money for collateral. We don't know what Argentina's collateral would be or how this would all work, but it does look like what their goal is to get Milei through the next couple of weeks until the congressional election down there, hoping that he can stay in power and he can continue his unpopular but the kind of reforms that the administration wants to see made down there.
Michael McKee, thank you so much for that perspective. Joining us now is Doug Rediker of International Capital Strategies, who's been covering and studying Argentina for a very long time. Doug, were you surprised by what was announced yesterday?
We certainly had enough flagging that this was coming that I guess I wasn't surprised. I'm following on what Mike was just saying. This is a unique use of the Treasury's instruments under its control under the ESF, the Exchange Stabilization Fund, in that law, the law that created the ESF, says it doesn't use the word swap. It doesn't contemplate a swap. It says actually there has to be an assured means of repayment. And as Mike was just saying, we haven't heard the details, but the details are pretty important. So I guess what surprises me is that the U.S. Treasury is effectively extending a loan by another name. They're calling it a swap, but it's actually a loan to Argentina on terms that we don't know about, but which seem as if they are unique in the history of the ESF, in that we are lending U.S. Treasury dollars to Argentina in exchange for something that seems to be at best of questionable equal value. A swap is we lend you, as you guys were saying, $50 billion for $50 billion worth of pesos. The question is, how do you define what $50 billion worth of pesos really looks like? That's the key.
Doug, why isn't the IMF doing this?
Well, the IMF has extended over $50 billion, the largest program in IMF history for the last several years. They've been doing this over and over and over again. It started back, 30, 40 years ago. I forget exactly how many programs. But at this point, the most recent IMF program, where the IMF extended $20 billion of additional funding to Argentina with $12 billion paid up front, was very difficult to get through the IMF executive board, because this is the classic case of throwing good money after bad. And so the U.S. put pressure on the managing director and the board, and they agreed to do it. That doesn't mean it was the wrong thing to do, but the idea was that $12 billion was supposed to be used to boost Argentina's reserves in anticipation of exactly where we are today. And instead of doing so, the Malay regime, which has otherwise on fiscal in particular done an admirable job of trying to right the Argentina ship, they just whiffed on this one. They didn't use the dollars provided by the IMF to boost their reserves. They are, by most accounts, negative net reserves today. And so when Scott Bessent says this isn't a bailout, I have to scratch my head and say, how are you lending money without collateral to a country that is negative net reserves and viewing it as something other than a bailout? It's a bailout.
Whatever you want to call it, the olive branch that the United States is extending to Argentina, is it enough to stop the bleeding in the financial markets in Argentina?
Well, I guess we'll see, but I'm not convinced. I'm not convinced largely because Secretary Bessent's argument on Fox last night was that the peso is actually undervalued. I don't think you're going to find too many people who believe that. And I think the markets are going to test that. So whether it is the structure that they're undertaking, this 400, well, we don't know how much they intervened yesterday, but the market rumors were that the U.S. intervened as much as $400 million worth of buying pesos naked in the market. At some point, that's going to be tested by the markets. Whether it is enough to get them through the October 26th midterms or not remains to be seen. But I have a hard time thinking that the markets aren't going to be scratching their heads and taking their pencils out and trying to test this, whether it's today, tomorrow, or the next day. It's going to happen.
There is an argument, though, and this is what Treasury Secretary Scott Bessent is talking about, that the U.S. wants to increase its presence in Latin America and have a greater competition with China, which has really increased its presence there. I'm just wondering how instrumental you view Argentina in that effort in terms of what they're doing, in terms of their alliances already.
So geopolitically, this administration, President Trump, really has a spheres of influence worldview, and Western Hemisphere down through Latin America is included in that. So it's a high priority for this administration, for this president, to try and exercise American dominance or control over Latin America. And the big impediment to that, amongst other things, including the will of the people themselves, is the Chinese presence. In Argentina, Milei came in and was very strident in his rhetoric against against China. The problem is what we started with, which is China has an $18 billion swap line outstanding to Argentina. If Bessent gets what he wants, if China says, you know what, we're washing our hands of this place, we're getting out of here, then from a matter of what that $20 billion swap line is going to be used for, that's almost dollar for dollar, simply replacing the $18 billion that China would be withdrawing. So Argentina is actually no better off. So we have to be aware that it might be a little too late to simply aspire to getting China out of Latin America and out of Argentina, because at this point, they're pretty deeply in. And are we as a country really ready, willing, and able to put up that much money to say we're going to replace every dollar of investment and swap exposure that China has in Argentina so that we are the big fish in town? You know, that extends beyond Argentina. What are we going to do in other countries in the region where the governments are not so friendly to the Trump administration? This is a big thing to try and bite off.
Doug Rediker of International Capital Strategies, thank you, and look forward to continuing the conversations next week at the IMF and World Bank meetings. But this really is a key question. And when I was in Peru last year, I was struck by how significant the Chinese presence was with Xi Jinping coming to open a port. How much is the U.S. willing to really compete with that in order to get a foothold on the copper reserves, on the other types of precious minerals?
And the Treasury Secretary said that as well last night in this Fox News interview. He talked about the recent export controls that came, more of them from China, and he said, look to what potentially mineral deals we can do in Argentina. They want to bring these economies closer together, and it almost was a Draghi moment yesterday. Whatever exceptional measures needed.
Coming up next, we speak with Katy Kaminski of AlphaSimplex, Tobin Marcus of Wolfe Research, David Tinsley of Bank of America Institute, and Republican Congressman French Hill. Good morning.
I'm not sure that the Fed can fully ignore what's going on with inflation.
There are risks that come from the inflationary side. Cuts seem a little premature.
Short-term rates are pricing more Fed easing over the course of the next 12 months.
The risk to look for right now is, can the Fed cut rates
as much as the market is presently anticipating.
I think they cut again, in part because they may not get me more official data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, heading into University of Michigan Sentiment Survey Friday, because next week isn't CPI week, and yesterday wasn't Jobless Thursday. And why not? Well, the U.S. government is shut down for the 10th straight day, with federal workers starting to not receive paychecks. And traders are reeling with a slew of international political risks, given that the biggest headlines probably are not coming in markets, because guess what? There is no data.
There's no data. We're still in this data desert. The government is still shut down. The one positive signal from Washington, D.C. is the White House has decided to deem some individuals at the BLS essential. They are going to start collecting the inflation data that we should then have at the end of the month. It'll be delayed, but we will get the data. In the meantime, everyone is grappling with other forms of data we can use. And you've been great on this, Lisa, in terms of corporate America. What are they telling us right now about the health of the U.S. economy and how resilient this consumer is?
So yesterday we got Delta. Incredible read on the U.S. consumer, and it pointed to real resilience, a real strength, not only at the front of the cabin, but also in the economy seats as well. A bit weaker there, I suppose. Levi's, though, and we keep pointing to that because we haven't talked about tariffs. Ajay Rajadhyaksha of Barclays pointed out we're not asking about tariffs, and yet Levi's said they're going to see a bigger than expected impact on the rest of the world, even outside of China, something like 20% in terms of the cost increase.
And how many more executives are actually going to come out and say it so bluntly? What's happening? Quote, we have started feeling the impact of tariffs. Remember months ago when Amazon wanted to put the tariff impact on the website? And then there was a huge drama between Jeff Bezos and President Trump, and there was calls going on. The Levi's CEO is saying we're starting to feel the impact. And what a lot of analysts have come on this program is saying, well, for the most part, companies have been eating it. What kind of impact can we see in 2026? How difficult is that going to be for the Fed?
And Levi's gave a sense of what impact they were seeing in terms of elasticity or consumer response to increased prices. And frankly, they're absorbing them. And that, to me, is going to be a question for the Federal Reserve. Meanwhile, market's not doing much this morning, which is really telling given the fact that everybody's gone home. John's been out today because why should he be here since it's University of Michigan Sentiment Survey Friday?
He's answering the call.
And we know, yeah, he's answering the call. We know how he feels about University of Michigan Sentiment Survey. Up just a touch in terms of futures, up about less than 0.1%. You are seeing a little bit of dollar weakness, but really a dollar strengthening underfoot that has been a real sea change from what we had seen for the rest of the year. And 10-year yields lower by about 3 basis points, 4.10, 4.11 round up. Right now, coming up this hour, Katy Kaminski of AlphaSimplex with Wall Street pressing a pause on the latest record rally. Tobin Marcus of Wolfe Research as President Trump and U.S. troops head over to Israel. And David Tinsley of Bank of America Institute with a consumer spending surge. We begin this hour with futures struggling for direction with stocks hovering around record levels. Katy Kaminski of AlphaSimplex are writing this. The rally has been somewhat broad with small cap ahead of big tech. Despite this, there are still concerns about the strength of the AI theme. And Katy joins us now for more. Katy, good morning.
Good morning.
So you're trying to find a trend. Is there any trend in what we're looking at, which right now feels just incredibly paralyzed?
Well, I think the interesting part is the only trend is all systems go. Equities have continued to move. We have been talking a lot about gold this week. I know it reverted yesterday, but really it's this lots of headlines, but nothing moving the markets. Government shutdown, everything is good, and, you know, it's kind of confusing to me sometimes.
Well, yeah, I think for all of us, I mean, when we take a look at how sort of bombastic some of the headlines are, and then you take a look at just sort of this quiescence in markets, I am wondering, one of the big movers has been the dollar. And we will get to gold in a second. But the dollar really has seen a strengthening, which has questioned or threatened some of the people who have big short positions on the currency. Do you think that that could be, based on your strategic research, that could be the beginning of something that really feels like a dollar strengthening rally?
Well, I think it's definitely possible, but we also have to remember that we have rate cuts on the horizon. So that's definitely going to be against the dollar coming up. But you have seen so much pressure on the dollar this year that there's a lot of extended positioning. And it's really moved so far that I think it's moved out of a range that people might be comfortable with. So that's why you're definitely seeing that potential pop up in the dollar that could continue, especially if stocks were to revert a little bit.
Is it also because of the timing? You know, political paralysis in France, you have an implosion of a 26-year tie-up in terms of the coalition government in Japan. So what else do you do if, you know, you've already done too much in gold? Maybe it's time now to recalibrate what's going on with the U.S. dollar.
This is a really good point because I've been getting a lot of interesting questions about gold. People have been going into gold with this idea that there's no real safe haven to look for. And maybe at some point, those are getting extended, and they're starting to think the dollar is actually looking like it's still somewhat of a safe haven, especially if we think that the news and headline risk has kind of gone past us, and the dollar is still kind of that strong currency that people see as that safe haven.
But also clients asking you at a time when we are in this data desert, and we actually don't know, hopefully the end of the month, we really don't have an exact pinpoint time frame and where we're going to get the gold standard economic data out of the BLS.
Well, this is a good question because I think in the absence of data, people seem to be perfectly happy, which is strange.
Ignorance is bliss vibes?
I guess so. I mean, you'd think that people would be reacting. We don't know what's going on, what this data is going to be. But instead, the markets are just still so focused on AI is great for the long term. The U.S. growth is still strong. And I just think it's going to take a couple of interesting data points to kind of change that narrative.
Do you think that there is any evidence that that narrative should be different?
Right now, there isn't. I mean, that's what I've been looking for. And I think the interesting part is more going to be once we have the situation where growth is strong and we have a potential for overstimulation, that, you know, we're in a situation where growth looks good, earnings look good, yet if we start cutting rates, that's a potential risk that I'm thinking about and seeing, is that then you could see issues with treasuries. So demand for treasuries, potential steepening in the yield curve, which we haven't seen yet, but we did see last month. And you see that gold position is the only indication that people are a little worried about maybe this is full throttle. Maybe we need to pull back.
I was reading a research paper yesterday saying that that whole idea of the dollar devaluation trade as being represented by the gold is really challenged by what we're seeing in the yield space. The fact that we are seeing demand at the long end of the yield curve, and you haven't seen that kind of sell-off that you would expect. I mean, how surprising has that been to you?
It's been very surprising because, you know, in this particular environment, you've seen almost no signal in fixed income in terms of trends. It's been sort of back and forth in terms of, are we going to eventually see steepening, then we see flattening? So I think we're going to need some sort of catalyst and some sort of realization. So things like CPI are very important to understand that narrative, and we're not going to know what that is. So that means that surprise or potential obstacle for bonds may just be delayed, which could actually make it more extreme.
It's been confusing, especially as we talk about the AI theme and we talk about electricity costs. We talk about the likes of Levi. I mean, if you look at the anecdotes, you can point to a whole different a group of nodes of inflation, whether it's Levi's increasing prices on jeans that we saw and people actually absorbing them. The only argument here is housing. And that, I guess, is sort of the question of whether housing and sort of the lack of a rebound there can provide a tailwind to the Treasury market in a way that single-handedly upholds it. I mean, how much are you looking at indicators like that, much more than you have in the past?
Oh, I think that's an important point because I always remember that inflation is the greatest enemy of bonds, right? And so if we start to see more data, especially in more idiosyncratic areas, it's just, I mean, you highlighted this perfectly. It's in some areas, but not in others. That means that it's not just a broad-based inflation effect, and it's also something we haven't experienced before. So this tariff, cutting rates, overstimulating the economy, we don't know where that inflation is going to come out, and inflation is very insidious. It can come in some places at one point and then not be observable until later in another sector of the economy. So it makes looking at multiple data sources like housing or retail even more important. So not just the inflation number itself, but drilling that down.
The Fed chair has talked about the fact that basically he's now re-anchored the Fed to the bias, to the labor market, and almost said you can look through these inflation prints. Is that going to haunt them in 2026?
It's quite possible because I think inflation is a very insidious force, and it will definitely show up where it hurts most, which is the bond market. That's where you're going to see that impact. I do think there's always a delay between how you see the reaction and the response with inflation. So it's also hard to tell at this point, but it's definitely a risk.
Could it be a place where the Fed start considering hiking interest rates, even though politically we know that there is a move to make a Fed that's more dovish?
I think that's a very low probability of that, just given the trajectory of sentiment with the Fed and all these questions about Fed independence. But, should we move to a point where, let's say, growth continues to be strong, the markets are still moving strongly, rates go down, we have some overstimulation, then a pop-up inflation, they're going to be in a situation where they have to answer to that. And most people do not like inflation because you feel it every day.
So for now, it just sounds like you put it all together. Your highest conviction is be long because there's nothing else to be?
I'd say yes.
Katy Kaminski of AlphaSimplex Group, thank you so much. Really appreciate your time. And a lot of people seem to be saying, stay long until it becomes a bubble and then get out. But we're not there just yet. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. French President Emmanuel Macron is expected to pick a new prime minister by tonight, following the resignation of Sébastien Lecornu earlier this week. France's caretaker finance minister Roland Lescure says the country is on course to meet its budget promises to the European Union, even after outgoing Lecornu indicated there will be less fiscal consolidation next year than previously planned. Meanwhile, Israel's security cabinet and the negotiating chief for Hamas signed an agreement to end their 2-year-long war. Iran-backed Hamas is set to return all of the remaining hostages held in Gaza, and in return, Israel is due to release almost all jailed Palestinians, plus allow a ramp-up of aid to Gaza through United Nations agencies and other international bodies. And Microsoft's data center crunch will continue into the new year as shortages of physical space and servers persist. Sources telling us here at Bloomberg, new subscriptions for Azure cloud service are restricted in some crucial server farm hubs. A lack of service to rent out to customers has been a recurring concern for cloud providers. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. And it's the reason why they say maybe it's better to overinvest than not invest enough, even if you end up overpaying. Up next, peace in the Middle East.
Peace in the Middle East. We secured the release of all of the remaining hostages, and they should be released on Monday or Tuesday. I'm going to try and make a trip over. We're going to try and get over there.
Tobin Marcus of Wolfe Research joining us next. This is Bloomberg Surveillance. Markets looking for something to chew on without any official data sources. Maybe they'll chew on University of Michigan later this morning. Maybe that's why John called out. What we're looking at right now is a rally because futures tend to do that. This morning, we're seeing about 0.1% gain on the S&P and NASDAQ, up 0.3 on the Russell. Some headlines coming out of CNBC reporting that the race to become the next Fed chair is now down to 5 from 11. The candidates are ones that we know well. Fed Vice Chair for Supervision Michelle Bowman, Fed Governor Christopher Waller, Kevin Hassett, who, of course, is the director of the National Economic Council, and then Rick Rieder over at BlackRock is also one of those selected, with Kevin Warsh as well, a former Fed governor.
So the two names that stand out to me is Rick Rieder, because he also got a pretty significant shout out in the Financial Times report from people close to the matter that have been part of these discussions and the interviews the Treasury Secretary is holding, and Mickey Bowman. Because Mickey Bowman has come to the Fed and really talked about wanting to get back to the basics, not what the Treasury Secretary would call mission creep. Also, the focus she has on regional banks. This has been an administration that continuously says Wall Street has done well for decades. We want to focus on Main Street. That is someone who brings regional bank experience and could be an interesting pick because we already know what's going on with the Kevins and Governor Waller.
Yeah, I do think it's interesting to have Rick Rieder there. Mickey Bowman has been on the Fed and definitely has been a stalwart behind a view that the administration seems to agree with. It's interesting that we haven't gotten one already because a Fed chair nominee, given the fact these names have been in the mix for a long time.
Right. How has the president not just blurted out who he's decided on? But I find this administration no longer has the urgency to talk about the Fed chair the way they did over the summer, because guess what? Jay Powell's cutting interest rates.
Meanwhile, under surveillance this morning, peace in the Middle East.
We reached a momentous breakthrough in the Middle East, something that people said was never going to be done. We ended the war in Gaza and really, on a much bigger basis, created peace. Peace in the Middle East. We secured the release of all of the remaining hostages, and they should be released on Monday or Tuesday. And that'll be a day of joy. I'm going to try and make a trip over. We're going to try and get over there.
Here's the latest. President Trump heading to the Middle East on Sunday as Israel and Hamas agree to end the 2-year war in Gaza. Bloomberg's Tyler Kendall joins us now. Tyler, do we have a sense of what President Trump wants to do when he goes over to Israel and how fragile this ceasefire still is?
Yeah, hey, Lisa. Well, we are still waiting on official confirmation from the White House on President Trump's itinerary, but he himself has said that he will visit Israel and that he's been invited to speak in front of the Knesset. He's also previously suggested that he could make a stop in Egypt, where we know that this final round of negotiations took place. Now, the Israeli government approved this ceasefire agreement overnight, and it's actually our understanding that President Trump's special envoy, Steve Witkoff, alongside his son-in-law, Jared Kushner, actually attended the Israeli cabinet meeting in what was considered to be a sign that this White House was very determined to see this over the finish line. But as you mentioned, there are still a lot of big questions here, including will the ceasefire hold? What will that future reconstruction of Gaza look like? As well as what is going to happen when it comes to that demand that Hamas disarm. Still, the administration is leaning heavily on regional partners. We heard President Trump yesterday in his cabinet meeting thank these countries by name, saying Qatar, Egypt, as well as Turkey have really played an instrumental role. And we know they're going to play a role in the security forces that are going to be on the ground as well, because Lisa, yesterday a senior administration official confirmed that 200 U.S. troops will be traveling to Israel. They're not expected to go into Gaza, but rather set up this coordination center where they will help to enforce and oversee security as well as the distribution of humanitarian aid, and they will also be supplemented by these other regional forces there on the ground.
Bloomberg's Tyler Kendall, great work as always. Thank you so much for being with us. Joining us now is Tobin Marcus of Wolfe Research. And Tobin, some of these international outreaches come at a rather awkward time domestically, considering that those troops going over with President Trump may not get a paycheck in the next couple of weeks. I'm just wondering how this is being read domestically, even as it is a great victory when it comes to peace, at least for now, in the Middle East.
Yeah, so certainly the peace deal is a genuine breakthrough. I think to the extent that it holds, it's a huge accomplishment and is going to play well domestically as well. You know, I think the questions domestically are many of the same ones that Tyler just flagged. Are we actually going to see Hamas disarm, which they have not really committed to doing, even though they're on board with the earlier, phases of the agreement in terms of hostage exchanges and so forth? And if Hamas does not disarm, does not quote unquote decommission their weapons in the language of the peace deal, will Israel really be willing to indefinitely suspend operations absent that step? So I think those longer term questions are still there, but for now, a very welcome breakthrough.
Yesterday, Caroline Leavitt was quote tweeting Fox News, which said the U.S. troops are headed to Israel to support the historic peace deal. And she said this is not true and taken out of context, that the 200 U.S. personnel will be tasked with monitoring the peace agreement. Is the administration going to face some blowback given the fact that President Trump has promised not to entangle the U.S. in international conflicts?
Yeah, I don't think that there's going to be a sort of major long-term U.S. peacekeeping role here. Again, there's lots of elements of this are still up in the air, but I think that the political resistance to, indefinitely having U.S. troops on the ground in a sort of enforcement or operational role is going to be sufficiently high that I don't think President Trump will want to do it. He's always resisted putting boots on the ground to a meaningful extent, even in situations where he's been happy to conduct air operations during both his first term and his second. So I think he's going to be very wary of extending the U.S. directly into this.
When it comes to active duty service members, including those 200 U.S. personnel that are headed to Israel, will they get paid next week, Tobin?
Increasingly, it seems like the answer is no, with the Senate having decided yesterday that they're going home for the long weekend after the vote that they took yesterday on the National Defense Authorization Act. There's not really sort of realistic story you can tell about Congress passing something that gets the government reopened in time to get those troops paid. So I think the only question about whether or not they'll be able to avoid missing that paycheck is if the administration can work out something using mandatory funding from the big, beautiful bill to pay them rather than the normal discretionary appropriations. That's been in conversation throughout the shutdown. There's been resistance to that on the Hill. We haven't seen any plan to that effect from the administration, so I wouldn't count on that happening, but I think that's the only remaining possibility, since it sure does look like the shutdown is going to extend past the point that would preclude those paychecks.
Will that be a pressure point for the government to reopen?
It's been one of the dates that a lot of people in Washington have circled, going back to September when we were going into the shutdown, and even more so since it started, this October 15th military pay date. at this point, it looks like something that's going to apply pressure after it happens. People will start hearing those complaints. Presumably members of Congress will start getting calls from their constituents with a very wide footprint of active duty service members across states and congressional districts, rather than something that they're sort of afraid to do in advance. I think one of the interesting political elements of this shutdown has been that the instigating party is not really getting the lion's share of the blame when you look at the polling. It's been somewhat surprising that most polls have said the Republicans have sort of the plurality of the blame, although there's plenty to go around, even though Democrats are the ones who are making the policy demand. And so I think that creates a situation where even as you look at these consequences, like missed paychecks, like air traffic disruptions, if neither side really feels like they're at fault or they're going to be blamed for it, it doesn't create the same urgency. So it's not like Democrats or Republicans are looking at that missed payday and thinking we can't possibly do that because they're hoping the other side will get the blame. So it does look like we're stretching on a little while longer. I'm still optimistic that we'll get a solution next week, but the odds of an even longer shutdown do seem to be rising.
Tobin, to that point, I mean, yes, the Democrats might not be getting the bulk of the blame for now. Do they have a cohesive message, though, other than we just want to fight?
Their message is healthcare, which is sort of the one issue that they still know how to message about. A moment when the party in general has been in shambles. The one thing they still have the muscle memory for is attacking Republicans for cutting healthcare, and that's really the message that they've set up here. And I think we have seen, as we expected going into the shutdown, that there would be increasing nervousness across various parts of the Republican Party about the rise in premiums as these Affordable Care Act subsidies expire, and as we go into open enrollment. That the political reality of that has gotten more concrete for a lot of the Republicans who are staring it down. And so we've gotten these interesting moves like conservative firebrand Marjorie Taylor Greene sort of going out publicly and breaking with leadership and saying, we really need to fix this. And leadership didn't really tell us that this was coming.
But Tobin, isn't this a policy error on the Democratic side? These enhanced subsidies have an expiration date based off the policy and the law they wrote.
Well, sure. This is a time-honored move, including both the 2017 tax bill and the tax bill that they just passed that the Republicans also did, which is figuring that you'll be able to get an extension of your more popular policies because no one's going to be willing to let them expire. So that was a Democratic calculation in 2022. These were last extended in the Inflation Reduction Act, and the limiting factor at that point was what Joe Manchin would be willing to vote for. They got him to go along with 3 years of these subsidies. They couldn't get him to go along with making them permanent. And so here we are. So, at some level, it's an error. But if they manage to get some deal on this, then it will have played out largely as they kind of hoped back in 2022, the same way that Republicans, successfully calculated in 2017 that they were going to be able to get these nominally temporary tax cuts extended when they came up for expiration.
Tobin Marcus, Wolfe Research, thank you so much. And right now, we are still in that data desert as a result of the government shutdown. Although, to your point, they are bringing people back from the BLS in order to get that CPI print to be able to calculate Social Security checks at the end of the month.
And if they are bringing people back, I wonder if they will deem essential the labor market report before the Fed meets, if they're still in a government shutdown, and potentially release it, because that's ready to go. We're just waiting for someone to push the button.
Yeah, and in the meantime, everyone in the market is taking time off, evidently, because right now we're seeing a pretty quiet start to the last trading day of the week. Coming up next is going to be David Tinsley of Bank of America Institute to really get a check on consumer spending. Guess what? It's staying solid. Plus, Danny Berger with your morning movers. Stellantis shares higher as shipments bounce back in the third quarter. This is Bloomberg Surveillance. Futures have a lift after some time this morning, looking up a little bit as you do see a rally into the bond space. And as a number of people say, look, how much can you get bearish amid the cash machine that is artificial intelligence? S&P and NASDAQ futures both up about 0.1%. Russell 2000 really seeing the outperformance, up about 0.33% because of the bond space and the rally that we're seeing there. If you take a look at 2s, 10s, and 30s, you can see the long end driving the rally. 30-year bond yields now 4.68%, down about 3 basis points after yesterday's auction that was better than expected. But across the curve, a rally in. 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, a tough morning for Qualcomm. Shares are down 1 1/3%. It is off the lows that we saw pre-market, but this was after Chinese authorities saying that they were probing Qualcomm over anti-monopoly measures. It has to do with a company they acquired called AutoTalks. It does auto technology, allows cars to talk to each other, and concerns that they didn't properly report that acquisition. So again, Qualcomm shares are off this morning. Elsewhere in this market, we see Applied Digital up nearly 25%, a huge move. As you were saying, Lisa, can you really be bearish on this when you have this opportunity of AI? This is a data center company, really solid earnings, and they said that they had a new lease agreement for CoreWeave. So you're involved in this digital economy. Investors snap up shares. Again, shares almost up by a quarter. Finally, this morning to the upside, Stellantis up 1.1%. Its deliveries rose 13%, and that was led by North America. Those deliveries up 35%. And it wasn't just small cars they were buying, it was big cars. Apparently the reintroduction of their V8 Ram truck, whatever that is. I'm in New York, so I don't know trucks, but apparently that was wildly popular. So those positive sales sending shares higher, Lisa.
Thank you so much, Danny. Appreciate that. On our radar this morning, the U.S. finalizing a $20 billion currency swap framework with Argentina's central bank. The Treasury directly purchasing pesos to help stabilize the exchange rate and prop up Argentinian President Javier Milei, who faces re-election later this month. Meanwhile, the Senate passing legislation limiting AI chip exports to China. The move requires NVIDIA and AMD to give U.S. companies priority access to their products before Beijing. The measure now goes to the House for approval. Meanwhile, China, for its measure, has come out, Annmarie, and talked about increasing restrictions on rare earths metals, which is creating ire around the world. But again, how much is this leverage and how much is this actually policy?
Tons of leverage. China has used this before, at least when it comes to rare earths, and it worked at the negotiating table. That's when we saw that U-turn when it comes to the H20 chips and whether or not they can go to China or not. But it's not even just rare earths. We are talking about constant tit for tat every single day. This morning, Qualcomm is now under investigation in China. Also, they're slapping levies on ships that come into their port that are American flagged. There's going to be a tit for tat between Beijing and Washington to the last moment before Xi Jinping and Trump sit down. And then what's going to happen is slowly these are going to unwind. That's the, I guess, for a lot of people in the market, best case scenario.
It does feel like this is the U.S. and China fighting. It's like mommy and daddy are fighting and the rest of the world is sort of feeling the impact of it. I found this fascinating, the fact that the German's finance minister came out this morning and was talking about how China's expansion of export controls to production facilities of rare earth minerals outside of China is a huge concern. And you take a look at their auto manufacturing sector, and it's really obvious why this is a big issue for them.
China is decimating the German manufacturing base and hollowing out what is going on in Europe in terms of their industries. And right now, Germany sounds a lot like the United States. German companies must reduce dependence on critical raw materials, including rare earths. And basically, they want to reallocate some of that work and do it in Europe. Well, that's exactly what this administration wants to do in the United States. And that's exactly what the Trump administration and even the Biden administration was pushing Europe to do as well. Make sure you're alongside what the U.S. is doing when it comes to competition with China.
Yeah, and meanwhile, people are looking at how the U.S. economy is actually doing. And guess what? We don't know. And why not? Because we're in a data desert. Meanwhile, the BLS announcing that it will release a September CPI report by the end of this month. The agency recalling staff to prepare the key inflation data needed to calculate next year's Social Security checks. Will this end up being the predecessor of some sort of reemergence of official data? We shall see. Nonetheless, maybe we can rely on something more than the University of Michigan Sentiment Survey. Turning to the consumer, household spending rising for 4 months straight, despite tariff pressures, according to the Bank of America Consumer Checkpoint Survey. Joining us now is David Tinsley of Bank of America Institute. David, thank you so much for being with us. The report was fascinating because it shows an increase in spending, but not necessarily an increase in incomes or an increase in the paycheck. How do you reconcile these two realities?
Well, I think on one hand, you've got consumers still spending in the overall US economy. You know, as you say, up 0.2, that was the last 4 months have seen a rise. So the overall consumer looks solid. But I think when we delve into the data, we see these divergences between higher income consumers and lower income consumers. So higher income consumers, their spending growth up 2.6% year over year. Lower income consumers up about 0.6 year over year. So there's this quite wide gap. And that's also reflected in wages and salaries as well.
So this is important, David. Are you basically saying that to the extent that the consumer resilience story is one that everybody keeps talking on and betting on in markets, it is one continuing to be resilience of the upper income consumer and not necessarily an overall read of the health of the U.S. economy?
Well, you know, I guess as a share of overall U.S. consumer spending, the higher and middle U.S. consumers make up a disproportionate share of that spend. So their spending kind of drives the economy, if you like. And higher income consumers, in a way, they have two clubs in their bag at the moment. They've got wage growth at 4% year over year. So that's real wage growth because inflation is below that. But they're also benefiting from these wealth effects from the higher stock market, for example, because wealth is so skewed towards that higher income cohort that they're really the guys that are benefiting from the rise in the S&P as well. So lower income consumers, weaker wage growth. It did tick up a little bit in the September data, 1.4% year over year, but quite a bit weaker. And of course, they don't really benefit from the, at least directly, from the S&P rallies or even housing wealth to a large extent. So I think, you know, they're in a tighter spot.
When it comes to spending groups, are you also seeing a divergence in terms of generations?
Well, yeah, this is quite interesting. This isn't such a new thing, but really over the last couple of years, in our data, the older generations, the baby boomers, traditionalists, they've been driving the spending growth. And actually, you see that reflected in some of the things that have been rising, like cruise line spending. Younger generations, so obviously millennials, Gen Z, but even Gen X to some extent, are in a much weaker spot in terms of their spending growth. I mean, why is that? Well, I guess for the young, you know, you have seen some labour market pressures in things like graduate unemployment rising above overall US unemployment. As you graduate at the moment, it's a little bit tougher to get a position. For Gen X, you know, increasingly they're in this position where they're potentially going towards retirement, they've got to save more, they might have older relatives, they might still have the kids at home. So they've got quite a lot of pressures on them, I think.
And this has impacted, of course, as well, housing equity, has it not?
Yeah, you know, I mean, there's a lot of equity in homes. It's not increasing that much because obviously the housing market is pretty stagnant. So consumers could, in principle, access that equity that's been built up over time through things like home equity lines of credit, HELOCs. What we look at in our data, which is the HELOC utilisation rate, so people who've got this facility set up, how much they're tapping it, it is picking up, but it's picking up relatively gradually. So I think that's not a major driver for the overall consumer story, but for some, as the Fed cuts and those rates become more desirable, it's going to help.
So, David, we're in a data vacuum right now in terms of the official government numbers that should be coming out. We should be heading into CPI Tuesday next week. Instead, we're talking about University of Michigan Consumer Sentiment Survey Friday. How much do you see some sort of resilience that we should be observing in the data, right? What would we be getting if we were getting that official government data? Well, you know, I think, I mean, we do this every month, rain or shine. So it's has increased focus right now, of course, because of the dearth of official data. I mean, I think what you'd see in things like the retail sales print is retail might be a little bit soft in September, but the overall consumer picture is pretty healthy. In CPI, I mean, we don't have too much to say on that in our report, but we do notice that when you look at transactions versus dollars spent in some categories of retail that are quite tariff sensitive, if you like, there is a divergence. So there is some tariff pressure probably coming through in the bottom line, but it's, you know, it's gradual and it's relatively modest. So essentially not necessarily contradicting anything that we're seeing in the corporate earnings or any of the other stories that speak to this consumer resilience for the most part. David Tinsley of Bank of America Institute, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here are your Bloomberg briefs with Yahaira Anand. Yahaira.
Hi, Lisa. China will begin charging special fees on American ships docking at its ports starting On Tuesday, the move comes in retaliation to a U.S. plan that charges port fees on Chinese ships. It marks a significant escalation in the months-long trade dispute and comes ahead of high-stakes meetings between the country's leaders later this month. Meanwhile, Amazon is rolling out an updated version of its main artificial intelligence tool for business. It says Quick Suite is a chatbot and set of AI agents that can analyze sales data, produce reports, or summarize web content. It's the company's latest effort to grab a slice of the market for software designed to automate and speed up office work. And Treasury Secretary Scott Bessent has narrowed down the list of candidates to replace Fed Chair Jay Powell from 11 to just 5. CNBC is reporting the following names made the list: Michelle Bowman, Chris Waller, Kevin Hassett, Kevin Warsh, and Rick Reeder. Trump's pick could be nominated to the Fed, though not necessarily as chair, by January. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And Chris Waller, who is speaking in a television interview, said that there is nothing political that he experienced in an interview for Fed chair, and that the Fed can use alternative data during the government shutdown. Are they calling ADP?
ADP, they're looking at open table bookings maybe. I'm sure they're looking at everything they can get their hands on, corporate America and the likes. Maybe it hasn't been political in these interviews. I will say, though, based on what I have heard about how this has gone when you walk into the Oval with the president, the number one question is, will you cut interest rates?
And that speaks to what he said, which is that the U.S. labor market is not doing great. Up next, standoff on Capitol Hill.
We will evaluate in good faith any bipartisan proposal that is sent over to us from the Senate if it decisively addresses the Republican health care crisis.
Arkansas Congressman French Hill joins us next. This is Bloomberg Surveillance. Building on what already has been a record rally, futures turning up as the session grows older, with bond markets still also rallying. What you are seeing is about a tenth of a percent increase on S&P futures. The dollar giving back a little bit after a pretty strong week, a reversal of what we had seen for the earlier part of this year, and a rally into bond markets. 10-year yields now lower by 4 basis points, 4.10. Just amazing to see how stable it has been over there, especially given the fact that the government has been closed for 10 days. And now we're looking at this data desert that leaves people spinning their wheels. Under surveillance this morning, standoff on Capitol Hill.
We will evaluate in good faith any bipartisan proposal that is sent over to us from the Senate if it decisively addresses the Republican health care crisis. It's got to be meaningful. It's got to actually improve the lives of the American people. But unlike Republicans, we are actually willing to sit down and evaluate in good faith anything that could advance the ball here.
Here's the latest. The partisan stalemate is dragging on in Washington, D.C., with President Trump threatening cuts to Democratic programs. Some federal workers are preparing for missed paychecks today as the shutdown continues for a 10th day. Arkansas Congressman French Hill joins us now. Congressman, thank you so much for being with us. Is there any progress being made? Is there a good faith effort to be getting in the room and talking about some of the details?
Well, good morning. It's nice to be with you. I think senators are certainly having conversations about what they'd be willing to do in the appropriations process after the government reopens. This is the issue. The House passed a clean, bipartisan, continuing resolution to have all of government open. And just yesterday, Chuck Schumer put a sign up saying, "We're getting stronger every day." Well, you know who's not getting stronger? People dependent on the flood insurance program who are concerned about storms or floods, people who are working in the military who know next week they get their last paycheck, people who are dependent on grant programs from the federal government to keep state child care programs open. That's who's not getting stronger every day. And so I would just simply say all the Senate has to do is pass the continuing resolution and keep the appropriations process going. So the answer to your question is yes, senators are having conversations about what they want to do in fiscal 26 spending, including on health care.
Chairman Hill, you just said the active duty service members, the military members will get their last paycheck next week. Is it your understanding they will get paid next week? Because I think there's still been a question mark about that.
Well, I think that's the last paycheck that I'm aware of is the 15th, and maybe it's not. But either way, this is why I declined my pay during this whole period, as I have in previous shutdowns. I don't think members of Congress, particularly in the Senate, should be paid while federal workers are furloughed, and some federal workers may well lose their job, when the simplest thing to do, Annmarie, is to get this government back open. We were in the middle of discussing all of the spending for fiscal 26. The Senate had passed 3 bills across the Senate floor. We had passed 4 bills across the House floor. And Susan Collins and Tom Cole have that process underway. And Schumer, I think, for internal Democratic political purposes, chose to pick a fight with Trump and try to make a name for himself once again. So the Schumer shutdown starts in his office.
Meanwhile, we do see the executive branch continuing along on a number of foreign policy issues, including Argentina. I'd love to get your thoughts on this $20 billion swap line. If they are using the ESF, isn't that taxpayer dollars going to Buenos Aires?
Over many, many years since the 1930s, the U.S. Treasury has used the Exchange Stabilization Fund when they think it's in American interest for geopolitical reasons, for global international finance stability reasons, by both political parties. Treasury Secretary Bessent's first trip as Treasury Secretary was to meet the leadership at the Malay government in Buenos Aires. I visited Argentina in August to assess the IMF program, assess their progress. For the first time of trying to return Argentina back to a market economy that people can be benefited from by low inflation, lifting kids out of poverty, created a private sector, dropping currency controls. So I think the Malay government is on the right track, and I think Secretary Bessent is trying to carefully and prudently see how they can encourage that success. If they're successful, they will rival the stories in Taiwan or Singapore or the Asian tigers, and they will reverse the curse of 150 years of mismanagement in finance in Buenos Aires.
But Chair Hill, I was with the Treasury Secretary when he went to Argentina in April, his first international trip. This is because of the midterm elections coming up, not some geopolitical issue.
I disagree completely with you. I understand that President Milei is having national elections in Buenos Aires on October 26th. That's true, and it's important that he keep the momentum going because they need legislative support for the reforms that they've made. But just in the first few months of his leadership, he's made substantial macroeconomic reforms that have improved the outcome, and individual citizens have been improved. So it's more than that. Argentina is an important strategic partner to the United States in the Southern Hemisphere for national security purposes, for shipping purposes, for global open navigation purposes. So it's a much bigger issue than just the fact that they have domestic elections coming up.
Congressman, the market is shrugging off all of what's going on, whether it's geopolitically or whether it's the government shutdown. And they're actually looking more to measures that you've put forward, including some of the deregulation of banks, including some of what we've seen with respect to easing some of the ability for tie-ups in the financial sector. As someone who has been a part of the financial sector in the small banking area, as well as who's been really a leader in this particular space, how much more do you see this continuing? Are you encouraged by what you're seeing? What kind of consolidation are you hoping for?
Well, it's not about consolidation. It's about right-sizing the role of government supervision and tailoring bank regulations. This began under the first Trump administration when we passed a bipartisan bill that was signed into law by President Trump back in 2018. And in that effort, we wanted to tailor regulation and supervision of our financial institutions based on their complexity, not just simply based on size. And that's been a theme that we've had for my first 9 months of leading the Financial Services Committee, as we want tailoring both in capital markets and in commercial banking so that we encourage banks to be able to stay successful, have the capital they need to lend to customers, whether they're building new homes or starting new businesses. And that had gotten atrophied under the leadership by the Joe Biden Fed. It was too bureaucratic, too paper intensive, and that's the focus that we've taken.
How much are you watching what's going on in financial markets, the unprecedented run in things like Bitcoin, the mergers and acquisitions, the leveraged buyouts that are starting to come back, and starting to worry that maybe things will begin to get a little too far? Is that something that is in your purview in any way?
Well, I do think there is a return of animal spirits in the market. You see that in the equity and bond market spreads. You certainly see it in the number of initial public offerings that we've had, the largest in probably about 5 years. And so there are elements of that, and you've seen a return to some merger and acquisition activity in some industries. All of that is true. It's not something that I worry about instinctively that it's happening, but can it be overdone? Certainly, and that's the nature of markets. We want a regulatory and supervisory system, both at the Securities and Exchange Commission and in the bank supervisors, that makes sense, that's focused on material financial risk, focused on information that investors need, focus our CEOs and boards of directors at banks on material safety and soundness issues, and not be distracted by, tertiary topics like, is making this loan going to have an impact on climate risk?
Arkansas Congressman French Hill, thank you so much for being with us this morning, and good luck as the negotiations do continue. Really interesting to see kind of these diverging issues, the idea of markets that see animal spirits at the same time that you see a real kind of conflagration of desires down in Washington, D.C.
Oh, yeah. The divergence is on full display. And also what we see is going on in the equity market is fueled by AI demand. At some point, that is going to become incredibly difficult politically. Electricity demand, the price is already skyrocketing. We're seeing in places around Texas where some people are actually having to line up and ask for federal help to pay their electricity bills. And not only that, all of these graduates coming out of school not having the menu of entry-level jobs because so many firms are starting to look at potentially using artificial intelligence.
Retraining programs and energy support is going to be the really key two issues going forward that maybe we'll be hearing about in terms of Washington, D.C. talking points. In the meantime, what we are seeing in markets is a bit of a lift to end the week after what we have seen, which is near record highs, led by the bond market, which does continue to rally. Coming up next hour, Paul Christopher of Wells Fargo, Sheila Kahyaoglu of Jefferies, Alejandra Grindal of Ned Davis Research, and Charlie McElligott of Nomura, as we do look to the potential for more of a data desert. University of Michigan Sentiment Survey. John is saying, I'm so glad I'm not there because you keep focusing on that. This is Bloomberg Surveillance.
The American capital markets is the envy of the world.
The equity market is doing really, really well, despite the economy not being particularly healthy.
People like myself, I think, underestimated that role of AI, and I think it helps explain the resilience of the U.S. economy.
Even if the AI narrative continues, it might challenge the fact that we look around and say everything is extraordinarily expensive.
As difficult as it is, and it is difficult to invest in these valuations, we think that you need to stay invested.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. John stayed home today since we're going to focus on the University of Michigan Sentiment Survey. After all, what else is there to focus on given that the government and all its data releases are staying closed and disrupted for a 10th straight day? We can go over what we might be getting if it reopens, which it probably won't. We would be getting that University of Michigan Sentiment Survey at 10 a.m. Eastern today, as well as a number of Fed speakers. Over into next week, we would get Wednesday CPI, we would get retail sales on Thursday, and we'd also get PPI, initial jobless claims, so much to chew over. Instead, Annmarie, we're looking down the barrel of just more emptiness.
We'd also get the jobs report, which we still don't have. That is done, that someone just basically needs to press the button and release. The issue right now, of course, is we're in the middle of a government shutdown. You just heard from Chair French Hill of the Financial Services Committee. Does there seem like any urgency based on the politicians we spoke to this week that they are going to reopen anytime soon? The Senate has left. It's a long weekend for them. So we're going to pick this story up on Tuesday, which means likely no data next week. But What the White House is doing is deeming some individuals essential, so at least they can make sure the collection of data is ongoing, so that by the end of the month, if the government does reopen, we do get CPI report and the others.
Well, if we want a CPI report, if we want any kind of data, we've been looking at corporate earnings. Delta, we mentioned, really demonstrating a positive read on the consumer, and Levi's indicating they're able to pass pricing along. Right now, what you're seeing in markets is a little bit of a lift as the session grows older, because ultimately people can look around, hate the valuations, as we just heard Cameron Dawson talking about, but ultimately having faith in this AI story of about 0.1% on the S&P and NASDAQ. Russell 2000 futures up about 0.33%. If you take a look, the rally is into the bond space as well. These two asset classes have been intimately connected for quite a while now. 30-year yields lower by 4 basis points after an auction yesterday signaled that, yes, there was plenty of investor demand, even if there was a concession. 4.68% after flirting with that 5% level not so long ago. Meanwhile, gold reprising its rally after yesterday's brief hiccup after seeing a 50%, more than 50% gain, continuing to turn upward in the market. Coming up this hour, Paul Christopher of Wells Fargo, as stocks are stalling near record highs. Sheila Kahyaoglu of Jefferies as airlines face the impact from the government shutdown, perhaps. And Alejandra Grindal of Ned Davis Research as we look ahead to University of Michigan Sentiment Survey, because what else do we have to look for? We begin this hour of futures struggling for direction with stocks hovering around those record high levels. Paul Christopher of Wells Fargo writing this: based on our expectations for accelerating earnings, we believe the next 12 to 15 months will favor U.S. equities. Paul joins us now. Paul, let's start there. The idea that people don't like buying into valuations like this. They don't like buying into consensus. They don't like doing it in a vacuum that is just because of government dysfunction. And yet it seems like that's the only place to go. Can you explain how that is somewhat of a difficult trade, yet an obvious one to many people, including yourself?
Yeah, I mean, surely it is uncomfortable for all the reasons that you mentioned. But, you know, you have to sort of focus here on what I'd call the big rocks. The big rocks are that artificial intelligence is a trend. It has some momentum behind it. It's investable, and we need to take advantage of it. Now, there's smart ways to do that and not smart ways to do that. And we're going to try to stick with the smart ways, and I'm happy to talk about those.
Okay, so let's talk about them. The smart ways to do it. Is it investing in the hyperscalers, or is it investing in energy companies that are going to have to fuel this over the longer term?
The answer is yes. But look, you've got hyperscalers in comm services, communication services, and in information technology. All right, so you've got two sectors there. Do you want to buy them both, or do you just want to buy one right now? Buy the one that looks the least overpriced, and then let's sit there for a while. And then at the same time, let's try to diversify that AI exposure by going with what I would call adjunct trends, like the data centers. You know, you've got some of these 2 and 3 ton computers right now around the country sitting under tents. So they're going to have to build places for those computers to live, and they're going to have to build out the energy infrastructure, not just to power them, but to cool them. Computers often have cooling below the floor. So utilities and industrials look like two sectors to us that are not as overpriced as, in fact, even attractively priced compared to information technology and comm services. And then a third way to diversify, or let's call it a second way to diversify, is to look for trends that aren't necessarily directly related to AI, but that play another big rock in the economy, and that's the fact that we think that the Fed we believe, is going to cut 2 more times this year and another 2 more times next year. That's going to take the short end of the yield curve lower, and with long rates, we think, hovering near where they are right now, that's a pretty good looking environment for banks, right? They're going to pay short-term deposit rates, which are going down, so their costs fall. At the same time, longer rates stay high, and that's what they're going to earn on their lending. So we can play different trends here in different ways that aren't as overpriced as the overall market or the individual hyperscalers, the Mag 7. So I think that's the way to go here. You want to try to be as effective with your capital as possible. And look, there are going to be pullbacks. So we're going to get to earnings season. There are going to be some disappointments, and those firms will be punished. Those could be buying opportunities. We'll have to see what transpires.
Well, I'm glad you brought up the energy demand that it's going to be for this entire AI boom. Electricity demand, do you think that could end up slowing this momentum because it might not keep pace with what these hyperscalers are trying to do?
Yeah, it's a good point. I mean, look, there are always going to be constraints when you're going through a growing trend, a growing pains trend like this one. This is a very disruptive economic trend. We saw the same thing if you go back to the 90s, right? There were shortages of things. If you go back to the 40s and the 50s and the 60s, we were developing automobile, ship, and air transport, and there were constraints there. We eventually broke through those constraints, and for investors, those constraints really represent opportunities, right? So as long as you see electricity production and transmission being constrained, that means there's opportunities in utilities. There's opportunities in midstream energy. There's now opportunities in natural gas. For a long-term investor, those constraints have to be worked through, and we believe they will.
Well, I want to know what you think of basically what you're doing in absence of U.S. economic data. Christian Nolting from Deutsche Bank earlier in the program was talking about how actually it's been easier without having the U.S. economic data. What have you been relying on?
Yeah, it is easier in a sense. You don't have reports coming out every day. But look, well, let's go back to the idea of the big rocks. For a long-term investor, what matters right here, right now, is that the economy is still growing. I don't think anybody doubts that. And that inflation is still moderate. I don't think anybody doubts that, really. And that combination, along with a labor market that's continuing to soften but is not generating a lot of new unemployment, that also tells us the Fed is likely to cut, the economy is likely to grow. We think earnings come up to $300 per share next year on the S&P 500. Those are the big rocks that investors really need to know about. The government shutdown, that's noise, it's distraction. Let's look through it.
Yeah, at this point, though, you have to wonder whether the strength that we're seeing in corporate earnings pairs with this idea of a Fed easing. We were talking earlier with Katy Kaminski of AlphaSimplex, and she said it is confusing to her that we're not seeing some sort of sell-off in long-term bonds as a result of the Fed presumably cutting 2 more times this year in the face of real strength in the U.S. economy. How do you manage that risk, considering that we really haven't seen much of anything in the bond space in terms of volatility?
Well, that is one risk on the long end of the yield curve, the maturity spectrum, and we would agree that that's a risk. We would see other risks as well. Potentially, the tariff revenue will not generate as many dollars as Congress thinks, and so you could end up with wider deficits going forward. So there is risk, we think, on the long end of the maturity spectrum, and that's why we've been underweight there for some time, for some months. We're also underweight on the short end, expecting the Fed to cut. So that really leaves us with a bullet strategy where what we really like is that intermediate portion of the maturity spectrum, the yield curve, that 3 to 7 year range, investment grade munis and corporates. That's where we would target. Look, you're going to get a yield in that 3 to 7 year range that's not far off of what it is in the 10 year. But you're going to get a lot less duration risk, a lot less risk from fluctuating long-term yield. So whatever the reasons are, yeah, we would agree that we want to be underweight long-term debt at this point.
Are bonds still the diversifier that they have been traditionally?
Yes, over time they have been, and I mean we've done the work behind this to show whether it's short-term or long-term in terms of the number of years you look at. Bonds are consistently the best diversifier for equities, on a regular and ongoing basis. At the moment, there's lots of trends that are churning around fixed income. So there's some buying in the fixed income space, pushing yields down a little bit. That's also tending to push more money into stocks. But that's just part of the normal give and take between those two markets. We would want people to hold both bonds and stocks because we don't want to try to predict when one is going to peak and the other one's going to trough.
Paul Christopher of Wells Fargo Institute, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. The U.S. has launched a bailout for Argentina, offering $20 billion in financing and carrying out a rare intervention to prop up the peso. Treasury Secretary Scott Bessent announced the currency swap and government purchases in a social media post. Trump's support for Argentine President Javier Milei comes ahead of this month's midterm elections in Argentina. Meanwhile, the Bureau of Labor Statistics has recalled staff to prepare the September CPI report because it is necessary to calculate the size of next year's Social Security checks. The agency was directed by the White House Office of Management and Budget to bring back employees to assemble the report in time for publication by the end of the month. And it was a stunning start to NFL Week 6 as the New York Giants pulled off a major upset on Thursday Night Football, defeating the defending Super Bowl champion Philadelphia Eagles 34-17. The Giants' rookie duo of Jackson Dart and Cam Scatibo led the way for Big Blue as Dart accounted for 2 touchdowns, while Scatibo powered his way to 3 rushing scores to secure the victory. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus Sheila Kahyaoglu of Jefferies as airlines get set to face the impact from the government shutdown. Have you booked flights recently? Are you concerned about this?
About flying domestically? Yes. Internationally? No.
Well, that's next. We'll get her view. This is Bloomberg Surveillance.
Senators are certainly having conversations about what they'd be willing to do. All the Senate has to do is pass the continuing resolution and keep the appropriations process going. Schumer, I think, for internal Democratic political purposes, chose to pick a fight with Trump.
That was Arkansas Congressman French Hill. As we reach day 10 of the government shutdown, both sides seem to be pretty dug in at this point. Right now, what you are seeing in markets is a rally that seems to be increasingly dug in as the session grows older. Futures now up almost 0.2%. Meanwhile, the dollar fading just a touch after a strengthening trend, counter to what we've seen for most of this year. And that rally building in the bond space is coming after Chris Waller said that he would be open to a quarter rate basis point rate cut at the next few meetings, and talked about a labor market that really is, as he sees it, under pressure. Time now for the morning calls. First up, RBC raising its price target on Tesla to $500, noting potential market share growth in the humanoid robot business. Those shares up about 0.33%. Next up, Evercore ISI raising its price target on Oracle to $350, expecting it to raise its revenue forecast. Oracle reprising some of the gains, up about 2.2% after a number of skeptical notes about the circular financing that we keep talking about. And finally, Bernstein raising its price target on Delta to $74. That's up from $59.80 right now. It's citing its premium demand in domestic travel. Those shares up 0.4% after a huge rally yesterday on the heels of an earnings report that projected real strength across the cabin. Sticking with air travel, flight delays rippling across the country as the government shutdown heads into its 10th day. Bloomberg's Tyler Kendall joins us now. Tyler, is there any sign that people are going to come back to Washington, D.C., or have they all left town for their long weekend?
Lisa, at this point, no one's coming back. According to the Senate, they adjourned last night. They're going to be back here on Tuesday. But no doubt this strain at airports nationwide is going to continue to ramp up the pressure on Congress as the government shutdown really does drag on, because we're seeing these flight disruptions across the nation due in part to this shortage of air traffic controllers who are being forced to work without pay, miss their paychecks amid this threat from the administration that they could actually lose their jobs permanently if they don't show up for work. Now, I think it's worth mentioning that during the last government shutdown in 2019, we heard from airport employees who said they had to pick up second jobs because they weren't getting paychecks, or they had to stay at home because they couldn't spend on childcare. And partly due to this pressure from airports, we saw that contribute to the deal that ultimately helped the government reopen. But Lisa, at this point, the data is pretty stark. The U.S. Transportation Secretary Sean Duffy saying that on average, air traffic controllers contribute to about 5% of the delays that we see at airports. That number has jumped to 53% in just the last week alone. I will point out that the problems have the potential to compound here. Lisa, the U.S. Travel Association says that the U.S. travel industry is estimated to lose $1 billion in spending each week that this drags on.
Bloomberg's Tyler Kendall, thank you so much. Sheila Kahyaoglu of Jefferies joins us now. And Sheila, as somebody who might or might not be interested for personal reasons as well as otherwise, how much are we seeing these delays really trickle through the airline industry?
We're seeing some delays, but, some select airports were closed yesterday for several hours, like Burbank. But in general, the airlines are telling us this is not going to impede travel demand, and we're going to continue to see momentum in the airlines. So It's unfortunate for the consumer, not so much for the airlines and the workers who aren't getting paid.
Essentially, people have to get places regardless of how much of a pain in the neck it is to get places. So it's not necessarily going to affect revenues for now. Nonetheless, does this kind of put a hitch in some of the airlines' plans? Particularly, I'm thinking United, that's been trying to really fight and counter some of the reputational risks around the likes of Newark.
Delta reported yesterday, and they gave us a range for Q4 of up 2 to 4%. And I think that range puts into account how long the shutdown lasts. Last time it was only about $1 million a day. This time they think it's going to be less than that for the last 9 days that they've seen. So Newark is always a highlight and a poster child for air traffic delays. So we'll see how United fares. Southwest has a slightly more exposure to government employees as well. But for now, we don't think it's going to stop travel demand. I'm out all week, next week traveling. I don't think I'm canceling my plans.
So you can give us a personal update on that
Yes.
if you're seeing delays. But we are seeing delays, and we're seeing staffing shortages across air traffic control towers around the United States. And we're 10 days in. What happens when we're 20, 30 potentially days into this shutdown?
Yeah, we'll see more and more delays, but unfortunately, we see 1 to 2% cancellations usually, and about 20% delays. So it'll just have people stay at the airport a bit longer, but that's all we have for now.
Do you think this is a pressure point for Washington, D.C.? Because 2019, when we saw massive delays in big airports like Orlando and New York, that day, President Trump caved, and then the government reopened. Could it come down to just, airlines and delays?
I think it's a lot more than that. I mean, if you look at the defense side of the business, Secretary Hegseth is talking about awarding the 6th-gen Navy fighter. This is during a shutdown. So I think the administration's trying to move forward, but we'll see what happens with the shutdown and how badly consumers are affected.
One thing that we've seen consistently through all the earnings reports has been, and I'm just moving to what we got from Delta yesterday, aside from the government shutdown, is that the front of the cabin has been the real money driver and the back of the cabin has been the laggard. And it sort of is a tale of two airlines, the ones that are able to cater to the business class side of things, the ones that are faring with the budget customers. Did we see a shift in tone yesterday from Ed Bastian of Delta?
I think on a number of fronts. Not only the discrepancy between main cabin and premium, that pricing Delta gap even wider, that was the first. Corporate was up 8% year over year. That was really solid. Cargo was up 16% or so year over year. Their MRO business was up 60%. All these stats were pretty positive economically, if you ask me. Some of it is market share gains on MRO and cargo, but still, those were pretty high percentages.
Well, that's where I wanted to go. Is this a read-through to the entire industry, or is what we're seeing a consolidation of market share in the likes of Delta, United, and American at the behest of some of the budget carriers?
I think both fronts. You're seeing United and Delta really outperform. They've picked the right strategy. We saw United add more routes to Europe yesterday. Europe would be the one area in Delta's report I would call out that was negative. The read-through on pricing in Atlantic revenues were down in Q3. That means there was either too much capacity or there was tariff-impacted bookings. So people that were going to book summer travel in March decided not to travel into the U.S. So that would be the one data point I would call it as weak. But going back to the airlines, it's the story of United and Delta winning, the strategies of Southwest and American and JetBlue needing to refocus their areas.
Did you see any evidence that the rest of the cabin, the people who are sandwiched into economy, are coming back, that the recovery that you're seeing in demand is also coming from people at the middle income, the lower income spheres of the population, rather than just the people at the front?
You saw that a bit. In the first half, we saw pricing for airfares down. In Q3, Delta's report was a turn positive, and they're forecasting an improvement in Q4. So we really needed to see that positive inflection in the main cabin in Q3, and we got that, and we're going to see more momentum into Q4. Some of it is because airlines are cutting capacity, so you're having less routes, and some of it is because the consumer feels more confident, and that was evident in their close-in bookings. They saw more and more cash sales.
What are you expecting from American and JetBlue based on what we've learned from Delta?
I think the Atlantic data point for American is one that we've highlighted as potentially being weak. They're the third carrier in the Atlantic. If you have too much capacity, not enough demand for multiple reasons, I think you'll see a weak report there. We're more bullish into United, but I think Delta put up a very clean print without any news, any other items to muddy the waters.
What about the budget carriers? Given the fact that Delta is saying, to Lisa's point, it's the entire airline, do you think the budget carriers are going to do well, or are those customers going straight to the big dogs?
We lean into the network carriers. I think Southwest adding routes into cities like Las Vegas isn't going to necessarily help their pricing momentum. But United opening up a route to Bari or Bilbao in Spain or Italy, I think that, ignites demand that wasn't necessarily there. That's a route that nobody flies directly from the U.S., and it could, instigate demand. Last year they did Greenland, so this year they stuck a little bit more conservative with their routes.
Sheila Kahyaoglu of Jefferies, thank you so much for being here. Really interesting point there that Sheila made, Annmarie, about the international travel for Delta and this question of whether it's tariffs, whether it's other issues, the international inbound class. That's the one area of weakness that you are seeing.
And the issue with tariffs, if you were looking to potentially not take that trip, not buy that car, well, once you have certainty, you're willing to maybe buy the car. But are you going to go take the trip now that it's October and it's a little bit cold when you were maybe planning on doing a summer holiday in Europe? No. So maybe you just say, I'll go next year. You can't make up for some of that lost demand.
Meanwhile, what you are seeing in markets is something of a rally that is building on the heels of these comments from Fed Governor Chris Waller, where he did say the job market was a bigger concern than any kind of inflationary pressure, saying that payrolls was likely negative. This in an interview this morning, that's giving a real boost to what we're seeing in the bond market and then giving a boost. The Russell 2000 futures up 0.4% now, Annmarie, really outperforming on the heels of the rally in the bond space.
And Governor Waller has been making this case for months. It was almost as if Jay Powell at Jackson Hole, the speech you were there for, almost it was like Governor Waller wrote that speech. He's been talking about the cracks in the labor market. What really concerns him is the north of 7% unemployment for college graduates. So it's no wonder here, this is where his bias is going to the end of October, whether or not we have the U.S. government data.
Given the fact that he is a potential contender to be the next Fed chair, his voice has a lot more clout in the market, as we're seeing this morning. Coming up next, Alejandra Grindal of Ned Davis Research as more U.S. economic data gets delayed. Plus, Danny Berger with your morning movers, the data that we do get. Levi's falling after warning tariff impacts are just starting to bite. This is Bloomberg Surveillance. Seeing a lift to the open as we get a little bit closer. Futures higher on the heels of comments by Chris Waller, Fed governor, when he said that he was looking at the labor market first and foremost and seeing a weakening that has ignited the stock market rally, particularly futures on the Russell, up 0.4%. It is because you are seeing a deepening rally into the bond space, particularly on the longer end of the yield curve, led by that 30-year denomination down 4 basis points to 4.68%. Similar kind of move in 10-year treasuries and a 3 basis point or 2 basis point move in the 2-year yield. 1 hour away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, we had earnings from Levi's and they upgraded their outlook. Their profitability is looking better. Yet this is what you're seeing, a decline of nearly 7.5%. Yes, the shares have run up, but the thing investors seem to be grabbing onto is the CEO saying that tariffs are just starting to bite. So that profitability they got because they were able to raise prices and people kept buying jeans, maybe that's limited for where we go from here. Elsewhere this morning, silver stocks are having a really great day. A lot of the miners here up at least 1.4% this morning with Pan American, First Majestic Silver. That's up 3.9% with silver, the precious metal, trading around record highs. It's outperformed gold. It's that whole fear, debasement trade, what have you. And also there's some real tightness and some oddities in the London spot market that also seems to be fueling a premium in New York. Meanwhile, we're looking at Venture Global, those shares getting crushed. This is the LNG company. It in a surprise loss in arbitration with another oil major. The concern is that this sets up potential litigation actions around its LNG shipments for those that face similar issues. So those shares down 18%, Lisa.
Thank you so much, Danny. Just picking up on what Danny was talking about, silver. It just really is remarkable to see up more than 70% so far this year. And I was looking at some statistics. The metal is used in things like solar panels and wind turbines. All of that industrial use accounts for more than half of the silver use. So this isn't just jewelry. It isn't just necessarily storing in your basement. And demand is set to exceed supply for the 5th consecutive year.
Yeah, there's actually a use case for this, which is a really good point. Unlike gold, where everyone just wants to basically flood into because they're nervous about central bank buying and geopolitical risk, silver is actually higher than gold has been doing. Gold is up 50% for the year, silver's up 70% on the year, and still counting.
Yeah, well, you're still to talk about some pretty big numbers at this point. Turning to the global economy and the historic U.S. investment in Argentina, Bloomberg's Michael McKee joins us now. Mike, you did a great job putting into perspective what this is like. Can you just give us a sense of how unusual this type of $20 billion credit line really is?
Yeah, it is the swap line, not the intervention in the currency markets, that's really kind of unusual. The U.S. has intervened in currency markets before, never on such a small level as Argentina. They've bailed out the euro and they've bailed out the yen. But the swap line is kind of different because ordinarily they're between central banks, and the idea is that the central bank that needs dollars will send their currency to the Fed, and the Fed will send dollars to that country for companies that need to repay loans in dollars. And then they will send it back, and the Fed will take a little bit of an interest rate gain on that. In this case, it doesn't look like we're going to be sending dollars. At least Scott Bessent says we're not going to be sending dollars to Argentina in that sense. Maybe more along the lines of guaranteeing loans, which is kind of what they did in the Mexican peso crisis back in 1994. Some loan guarantees, and then the U.S. bought some of the Mexican paper. But we don't have any details yet. And of course, there are people who are noting that a lot of people who are in the hedge fund business and worked with Scott Bessent in the past have bought a lot of distressed Argentine debt and wonder if he's trying to help them out. He's not going to tell us, but that could be an ancillary benefit.
Mike, in the meantime, we're talking about this as we don't have really official data to talk about. We're going to be focused on the University of Michigan sentiment survey that comes out in about an hour and a half. But then we would be getting CPI, we would be getting retail sales, we would be getting PPI and unemployment claims next week. But it looks like right now we're not going to get it, right?
Well, we're not going to get it next week, but we may get CPI. The Michigan numbers are going to be important today because of the lack of other data. It's the inflation expectations number that you can see there. That's the 1 year that is going to matter to the Fed because they're trying to keep inflation expectations grounded. We did see in the New York Fed version of inflation expectations that they went up on a 1 year basis to 3.4%. They run a little bit hotter in the Michigan numbers, but if they stay where they are, and not rise, that would be some good news for the Fed. Now, as for the CPI, the Bureau of Labor Statistics said last night that they are going to bring back some employees and put together the data that they had already gathered in September of the CPI and try to get it out by the end of the month. Their goal is to have it ready because it's used in the calculation of Social Security cost of living adjustments. But if they can get it done by the 29th, when the Fed meets next, it would be a big help to Fed officials trying to figure out what's going on in the economy. The one thing they have not explained with this, though, is why they don't put out the employment report, because that's already finished. They don't have to bring anybody back to do it. They just have to push the button. So that's a question still out there for the BLS.
Yeah, Mike, great point. Michael McKee there. Thank you so much for that. And Chris Waller was saying that he thought it would likely be a negative payrolls number had we gotten it. Alejandra Grindal of Ned Davis Research joins us now. Alejandra, it's so interesting. We don't have the data coming out of official government sources. We do have the data coming out of the hyperscalers that just shows incredible investment and profitability. Is that essentially what everyone has to hinge their bets on at this point in the absence of anything else?
At least for the time being. Thank you for having me again. And I do want to point out that there's still a fair share of private sector data out there. So even though we're not getting as much of the public sector data that we've been used to getting, we'll have the PMIs, the ISM, NFIB. You mentioned University of Michigan later today, Conference Board data. And, you know, I'll be honest with you, I'm also a global economist, and I have to deal with a lot of instances where there isn't much data, certain countries, especially some emerging markets. So if you look at it in the whole realm of things, we're not necessarily flying blind. We're definitely dealing with less information, but we're not flying blind either.
Are you saying that this is a good time to look at the template for emerging markets and take out that playbook and follow that in the absence of everything else? What is it showing if you are looking at the other data points that are available? Does it confirm this idea that Chris Waller was talking about, that the labor market really is flagging? Or does it confirm this idea that the stock market seems to be rallying around, which is that everything is great?
Well, so most of the data is telling us that we're seeing slowing economic growth, but no recession. So the stock market usually continues to rally as long as we don't have a recession, right? But in terms of some of that job market weakness, that's why the Fed has intervened. We have seen some job market weakness, and we actually did start seeing that in other data even before we started seeing it with the payrolls data with the establishment survey. Some of it was official data, such as the JOLT survey, but we were starting to notice some weakness in jobs through some of the survey data, such as the Conference Board's Consumer Confidence Index, some of the NFIB data, and even the ISM data.
So if we have a weakening job market, what you talk about is below trend growth in the U.S., but not a recession. So what kind of environment is this?
You know, it's a lot of it is just an environment that's being held down by near-term uncertainty. You know, at Ned Davis Research, we tend to focus on a lot of data, and most of the data we look at will look for, you know, what are called like recessionary thresholds that look at a broad array of data. And for the most part, they're not really giving us an indication that recession is a near-term concern. And we have gone through periods where we've had below-trend growth and no recession.
How do you feel about inflation now, the fact that, as Lisa has brought up today, we're hearing companies talk about it like Levi's, that they are passing on these costs to consumers?
You know, for the time being, we do. And I think last time I was on the show, I said the same thing. We do see upside risks to inflation, obviously coming from the tariff perspective, but I think also a very underappreciated source of upside inflation can come actually from a lot of the deportation policies that are seeing a decline in workers in certain services-related industries and agricultural industries. So we do expect a modest upleg in inflation. Up until now, yes, you mentioned Levi's. They have a lot of consumer goods tend to have smaller margins, so they may have to pass on the higher costs. But up until now, we have seen businesses absorb a larger share of the tariff costs. The issue is this going to be just a one-off thing, or will it continue for longer? And that's really the question up in the air, and something that the Fed needs data for to be able to gauge. We do anticipate that the Fed will reduce rates, but how much they end up going, whether they actually get to neutral, will depend on how long this tariff impact happens. And the longer we see prices accelerate, even if it's modest, if it starts impacting inflation expectations, then that ultimately could become a self-fulfilling prophecy. And that's really what we'll be watching.
Has it surprised you, Alejandra, that we haven't seen those expectations of higher inflation priced into Fed funds futures, whether it's the long end of the yield curve or even just inflation expectations in break-even rates?
Yeah, it's a balance of risks. And so for the time being, because the market-based measures of inflation expectations remain fairly stable, we are, reasonably confident that we won't see runaway inflation, but we'll be watching it because we are seeing it within the consumer measures. Mike McKee mentioned it earlier. We'll probably see a little bit with University of Michigan today. And if it moves further and further, then it might start impacting the market-based measures. But at least the fact that those have remained, fairly stable gives us some hope that the impact of tariffs will be relatively short term.
Meanwhile, the incredible rally this year has left a lot of people nervous, and they've been trying to poke holes in it. And earlier this week, we talked a lot about the potential for an AI bubble. And then Microsoft comes out with this overnight where they forecast data center crunch persisting into 2026. Is there just this fundamental drive that really does force any kind of bearish sentiment around the hyperscaler space or the AI rally that we've seen to just go away and hide in the corners for a little bit longer?
Well, that's the fundamental question, right? How long can that work? It's a lot of also what's been driving the economy, right? Like if you look at capital expenditures, we're seeing quite a bit in the AI space, and that's what's, keeping that element of the economy afloat. And then it's driving markets. And for those who own stocks, that's creating a positive wealth effect, and it's keeping people spending, despite the fact we're seeing some of these job concerns, especially keeping spending within the higher income levels. So that's definitely driving that story. Whether it's excessive optimism, we have a lot of measures in-house that try to measure optimism, and we're not seeing excessive measures yet. I think there's still some people sitting on the sidelines sideline because they're concerned about the impacts of the Trump administration. There could be other folks sitting on the sideline, but we could be getting closer to that point, but I don't think it's coming at least within the next few months.
Alejandra Grindal of Ned Davis Research, thank you so much for being with us and have a wonderful weekend. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The 72-hour period to release the Israeli hostages has begun. Steve Witkoff, the U.S. Special Envoy to the Middle East, says the ceasefire agreement between Israel and Hamas started at noon local time. President Donald Trump is planning to travel to Israel on Sunday to be on hand for the release of the hostages. He also said he might address Israel's parliament. Meanwhile, Maria Corina Machado of Venezuela has won the Nobel Peace Prize. Machado won for her work promoting democracy and decades-long struggle against authoritarianism in Venezuela. Machado has been in hiding for more than 14 months after Nicolas Maduro declared victory in last year's election. President Trump's assistant posting on X, Nobel proved they place politics over peace after the announcement. And Apple will expand the roles of some top executives as Chief Operating Officer Jeff Williams prepares to leave the company. Services Chief Eddie Q will take over Apple's health and fitness teams, and Craig Federighi will oversee the Apple Watch operating system. The moves come ahead of the planned launch of a new subscription service dubbed Health Plus. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Have a wonderful weekend, and thank you for this morning. I can't wait until we don't have doctors anymore. We just have wristwatches that tell you, please stop eating that. That's what I imagine.
Or rings.
Or rings.
That tell you that you're not sleeping enough.
Or little humanoid robots that tell you to go get more exercise. Up next, setting you up for the day ahead. Plus, Charlie McElligott of Nomura saying that investors are not shying away from the AI trade. I know you all were wondering that. Looking today, again, NASDAQ futures up ahead of the open. This is Bloomberg Surveillance.
You try to get everything you get from the data perspective. So for example, ADP, when you don't get the non-farm payrolls, you really watch closer. But of course, you need to take into account what kind of indicators are there. And I think, for a certain period of time, you probably can fly a bit blind from the data perspective.
That was Christian Nolting of Deutsche Bank, who said it was easier without all of those data points that you have to analyze, considering the fact that things are still tugging along. Counting down to the opening bell, here's a trading diary into next week, 10 a.m. Eastern, University of Michigan Sentiment Survey. Also today, rounding out the week with Fed speak from Goolsbee and Musalem. 5 p.m. Eastern, President Trump is making an announcement. Next week, more key economic data that we're probably not going to be getting. On Wednesday, we've got CPI data, or we don't have it. On Thursday, PPI and retail sales are supposed to come out with that additional round of jobless claims that we did not get this week. Turning back to markets, Charlie McElligott of Nomura writing, in spite of such euphoria in asset prices leading to what many would expect as caution, the client refrain for many now is you cannot own enough AI trade mega cap tech. Charlie joins us now. Charlie, thank you so much for being with us. I have to say, it seems like in the absence of data, the buy AI trade only gets stronger because ultimately the data that we do get just continues to support it. Is there the skepticism in your clients that we hear from investment analysts sometimes on this show?
No, there really isn't. I mean, look, there's dual narratives right now. The AI, the AI phenomenon has been, massive with regards to the CapEx, and now this very kind of self-referential, self-reinforcing financing dynamic. And that's been part of the high water raising all boats with regards to markets and easier financial conditions. But macro-wise as well, there's been this kind of fiat currency debasement trade, right, where governments are running fiscal hot, heavy deficit trajectory, the spending in conjunction now with central bank easing. And when you have all of that working together, it's creating more of this kind of pro-cyclicality, both in markets, market forces, economic forces. So people are more concerned right now, just having my big macro quarterly dinner this week, more concerned about missing the right tail than they are about downside, even with markets at highs.
It sort of raises this question, especially when you talk about the debasement trade and this monetary and fiscal bazooka that it seems to be firing on both cylinders right now. A question of whether the AI trade is viewed as almost safer than some of the more traditional ones. And I put it in safe in quotes, but the idea of that being more reliable than, say, government debt or credit in certain spheres.
Yeah, for sure. I mean, look, these companies are, and the big difference between this time and, kind of the tech bubble, right, is that this is not, a dream per se, right? These companies are generating massive profits and cash flows. And so far, that's been most of the financing of this pursuit of the chips and the centers and everything, with regards to the kind of the Delta One around that, the halo of the energy providers and the utilities and all that stuff. The thing is that these companies are super high quality, obviously, very highly rated debt as well, at a time where bonds haven't worked, right? And you want to speak to about this kind of speculative environment, the speculative backdrop, right? It's not just risky assets. It's not just the AI right tail. It's short volatility strategies, right? Short volatility strategies have kind of become this new tool for income generation in a world where bonds haven't worked for 5 years because we've been running, above trend. So they're quality, they're big cash flow generators. They have this story to them. They keep going up. They're liquid. There's a lot of stuff going for it right now. And honestly, right now, imminently, it's going to take some sort of a margin shock, that currently is not out there, that the market has not really felt, to sway them from this trade. And it keeps, again, working with these market forces, particularly, the stuff that I care about, options and leveraged ETFs. It just feeds us higher.
Does it give any of these investors pause, though, that all these deals are rather circular?
They are, but I think, again, the difference being that there's real money that's being made right now. Real money, real profits, real cash. The thing that I think can inflect us as we go forward here is this idea that, and you've already seen this with Oracle, right? And you've seen, the Oracle kind of, the debt ratios really change, where you're talking now about bringing debt because you're burning through so much of your cash, right? Cash has been a huge part of the buyback story for 15 years. When corporates learned with, how well rewarded you could be with buying back your own stock, that's become that was probably over the past 15 years, the largest single source of demand for equities, and it's a vol suppressor, right? You're shrinking the float, you're stabilizing bid under the market, and then when stocks are selling off, they're even more aggressive. If that cash is now being burned through in pursuit of this, CapEx euphoria, and you start now having to bring more debt to kind of fund all of these things at the same time, the risk here, and something that I'm watching closely in coming quarters, is if you see that almost perpetually higher announced buyback number across S&P 500, which is largely these AI mega cap tech companies, if that starts turning lower at the same time that the debt issuance from these companies is moving higher, because that now has to be brought in too to fulfill all of these obligations, that's something that I'm going to watch. Because again, that buyback bid to stocks has been the number one source for stocks over the past 15 years.
Jonathan's made this point a lot, though. The market is rewarding these companies for doing that, for levering up.
Well, I mean, but it's still really, really low leverage. And look, this has been a talking point too this week at at the macro dinner, our credit discussion. People are nervous, kind of on the outside looking in with regard to First Brands and Tricolor and, delinquencies at Carvana, wondering if some of this clustering you're seeing in pockets of like asset-backed or super subprime space is something bigger. And it is going to be part of the story next year because tech is now the largest part of kind of IG issuance. That's a big story. If this kind of keeps perpetuating where you have to bring more debt to finance these pursuits, and it's somehow also, too, at the same time, impacting the amount of stock you're buying back, it's something to watch. But again, these companies are incredibly cash flow positive, incredibly high quality because they're so profitable. So that's an inflection in the future, but that's not a now issue.
How much are people stretching outside of the hyperscaler space in order to get returns, in order to get alpha, given the fact that it's a pretty played out trend, if not complete, on the hyperscalers?
Yeah, so, I mean, the fear of the right tail is taking prominence, as we've spoken about. And I think the last time I was in here, I was talking about this kind of people were in the bunker. So we've moved from the bunker to the fort, fear of right tail. In this case, people now, and this tends to corroborate what you're seeing with regards to an early cycle move, right? Fed cutting into an early cycle economic reacceleration. You're now moving into really high beta, junkier stuff. So like unprofitable tech has been on a tear. Short basket's been on a tear. A lot of these things up 15, 20% in the past week and a half. So you're seeing elements of that. Obviously, you've seen crypto move to new highs, partially as a function of dollar debasement or fiat debasement, most recently the yen with regards to the elections there. So you're pushing into like the wingier stuff, which is providing that extra beta. It's silver, as you spoke about earlier, right? Silver is, the junky high beta version of gold, and it's acting that way even with an industrial purpose, right? That's where you're getting your juice. Call skew in these things, right? Demand for out of the money stuff versus at the money, 95th to 100th percentile, all this stuff. So people are reaching because they're worried about this right tail and all this stuff because you have a career anxiety right now. It's performance anxiety, like it's existential. If you don't capture this, you're cooked. The trick here now is that at one point does all of that suppressed volatility, all of that exposure built off of the suppressed volatility, all of the leverage into the highest beta stuff, oftentimes that tends to tip over and kind of collapse under its own weight. And that's what I'm conscientious of. So like I'm constantly looking at like where are people hedging, and it's the VIX calls, VIX upside, VIX call spread space.
Charlie McElligott, thank you so much for being here.
Good
Wonderful to have you. Yeah. Let's do it again. Charlie McElligott of Nomura with the meme metals with silver. I love that. That's a fantastic way to look at it. Coming up on Monday, Peter Shear of Academy Securities, Alessio DeLongis of Invesco, Seema Shah of Principal Asset Management, and Jean Beauvais of BlackRock. Thank you for listening. Have a wonderful weekend. This was Bloomberg Surveillance.